morning, good afternoon, and good evening to ladies and gentlemen. Welcome to webinar Financial Development, Digital Transformation, and Economic Uncertainty organized by UNS Fintech Center and supported by the Bank Indonesia, Indonesia Financial Service Authority OJK, Indonesia Deposit Insurance Corporation LPS, and Bank Jateng. I'm Doni and it's such a pleasure for me to be part of this conference. And before we start, I think I would like to also welcome to all of the honorable invited speakers and attendee, Professor Sajidan, the Vice Rector of Planning and Partnership Business and Information, Universitas Desmaret, Mr. Imansyah, Deputy Commissioner of OJK Institute and Digital Finance, Indonesia Financial Service Authority, Mr. Doni Joewono, Deputy Governor Bank Indonesia, Mr. Didik Madiyono, Member Board of Commissioner Indonesia Deposit Insurance Corporation, LPS, Mr. Nugroho Joko Prastowo, Head of Solo Bank Indonesia Representative Office, Dr. Supriyanto, President Director of Bank Jateng, Professor John Goodell from the University of Akron, USA, Professor Muckley, University College Dublin, Ireland, Professor Haitian Lu, Hong Kong Polytechnic University, Hong Kong, Professor David Lee, School of Business Social Sciences, Singapore University, Dr. Wong Yong, University Tungku Abdul, Malaysia, and last but not least, Dr. Putra Pamungkas, researcher at UNS Fintech Center, Universitas Desmaret. It's such a great pleasure for us to have all of you in this webinar. I would like also to inform you that this webinar also part of the agenda of 45th anniversary of Universitas Desmaret. And to formally start this webinar, I think without further ado, let me invite Professor Sajidan as the Vice Rector for Planning, Partnership, Business, and Information, Universitas Desmaret to deliver opening remarks. So, good evening, Prof.
Okay, thank you, Mbak Dewanti.
Platform is yours.
Okay.
Please.
Assalamualaikum warahmatullahi wabarakatuh. Good evening and good morning. The most honorable, the chairman of OJK, Professor Wimboh Santoso, today represented by Mr. Imansyah, the Deputy Governor of Bank Indonesia, Mr. Doni Joewono, and the member of board of Indonesia Deposit Insurance Corporation, LPS, Mr. Didik Madiyono, respectable all speaker in this webinar, Mr. Dr. Supriyanto, President Director of Bank Jateng, Professor John Goodell, University of Akron, USA, Professor Carl Beckley, Ireland University College, Dublin, Professor Haitian Lu, Hong Kong Polytechnic University, Professor David Lee, Finance Program School of Business Social Science, Singapore University, Dr. Wong Yong, University Tungku Abdul Rahman, Uttar, Malaysia, and Dr. Putra Pamungkas from Universitas Desmaret. First of all, on behalf of Universitas Desmaret, UNS, it is a great pleasure for us to welcome you to this event. More than 650 participants registered here, not only from our university, but also from other institutions in Indonesia and also outside Indonesia. This event is organized by the Center for Fintech and Banking, UNS, a center of excellence in science and technology in UNS that is granted the first grade in the assessment of the Minister of Education and Culture in 2020. Please give applause to UNS Fintech Center for Banking. Yeah. For this assessment is very well. This event is also part of the agenda for the 45th anniversary of UNS. Yeah. Today we will study and learn, especially our keynote speaker from Professor Wimboh Santoso, represented by Mr. Imansyah, and also from Mr. Doni Joewono, and Mr. Didik Madiyono, and a prominent speaker in economic, banking, and finance. This speaker will discuss a various issue in finance development, digital transformation, and economic uncertainty. And we will have great knowledge because some of them are from the United States of America, Europe, and also from Asia. At this time, the world is facing great economic uncertainty due to the COVID-19 pandemic. One can argue that pandemic has pushed innovation to its limit. Yeah. The disruption pace which continue to the accelerate pace, and at the same time at a challenge and the regulator to cope with the acceleration. Yeah. How to manage this disruption and acceleration of digital transformation is the subject of much discussion. We will see the perspective from the speakers today about how the recent development of financial development and digital transformation and some strategy to could be executed under economic uncertainty. Our university has committed to contribute to sustainable development, not only at the national level, but also the regional and international environment. As we are fully aware that in today's globalized world, to contribute of universities should be promoted to a wider spectrum. We hope that you enjoy the event today. Once again, thank you to all speakers who given the time to share the knowledge with us, and also thank you for all participants. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Prof. Sajidan, for such enlightening, welcoming remarks for today's webinar. And once again, congratulations also to UNS Fintech Center as #1 of Center of Excellence in Indonesia. And I think it will be good for us to have documentation for today's agenda. So I would like to invite all of the invited speakers and attendees, also along with the participant, to turn on the camera because right away we will have the virtual photo session. So please turn on the camera. Okay, so in count of 3, let's have a big smile to document this event. So 1, 2, and 3. Thank you very much to all of the participants, and already mentioned by Prof. Sajidan that this webinar is, we have around updated data, we have around 700 participants registered. So it's supposed to be a great honor for me also to joining in this webinar, and really hope that the discussion of today will bring the beneficial to all of the participants also. And let's proceed to the keynote speech agenda, because today it's very special. We will have a 3 keynote speech that will be delivered by 3 different parts of the regulator concerning to in the financial area in Indonesia. And for the first keynote speech will be given by Mr. Doni Joewono. He is the Deputy Governor of Bank Indonesia. And I think we will see how the central bank sees our theme today, the financial development, digital transformation, and economic uncertainty. So without further ado, proudly bring up to you Mr. Doni Joewono.
Distinguished speaker and panelists, Professor Jamal Wimboh, Rector of Universitas 11 Maret, Professor Wimboh Santoso, Chairman of Indonesian Financial Services Authority, OJK, Mr. Didik Madiyono, Member Board of Commissioner Indonesian Deposit Insurance, Dr. Supriyanto, President Director Bank Jateng Indonesia, Professor Goodell, University of Akron, USA, Professor Haitian Lu, Hong Kong Polytechnic University, Professor Muckley, University College Dublin, Ireland, Professor David Lee, Singapore University of Social Science, Dr. Wong Yong, Universiti Tungku Abdul Rahman, Malaysia, Dr. Putra Pamungkas, Universitas 11 Maret, Surakarta. Honorable participants, ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh, and very good afternoon from Indonesia to all of you. First of all, let us extend our praise and gratitude to Allah Subhanahu wa Ta'ala, God Almighty, since only with His blessing we all could participate here virtually in the Universitas 11 Maret this Natalis, even on international seminar, financial development, digital transformation, and economic uncertainty. It is such an honor for me to have this valuable opportunity to attend this event. Even though the seminar is held virtually, I hope it will not limit us from having a collaborative discussion and providing a valuable enlightenment to all participants. Distinguished speaker and ladies and gentlemen, in the past decade, we have witnessed the wave of digitalization and its diffusion into our life. Digital technology has developed at an exponential pace since the introduction of the wireless network in the 90s. As the internet began to be widely used in early 2000, it was transformed into a strategic infrastructure for any modern society to support economic and financial activity. Those development in turn has changed the interaction and behavior between economic agents. The economic and financial activity is heading toward a new model that is no longer akin to what was have already perceived. Furthermore, as we know, the COVID-19 pandemic had altered the way we live toward contactless communication and physical distancing approach. On this condition, we still want economic activities to keep on going while adapting COVID-19 protocol in a disciplined manner, among others by physical distancing. Thus, digitalization is indeed important. In Indonesia, digital transformation in various sectors has been proliferating and will be even more amplified in the future. Based on Bank Indonesia data from the 4 biggest marketplace in Indonesia, the COVID-19 pandemic has brought blessing to Indonesian e-commerce. Value transaction in Q4 2020 reached 90 trillion rupiah, an increase of the 28% quarter to quarter, and then transaction volume also increased by 31% to reach almost 372 million transactions. Growth of e-commerce transaction was driven by the widespread acceptance of e-commerce in the community, as reflected in the increase in the number of buyers by 22%, or reaching 78 million. This is the highest since Q2 2018. Distinguished speaker, ladies and gentlemen, digitalization brought us new opportunities and chances. It has resolved physical infrastructure barrier, also lowering cost of transaction. Digitalization has also made financial services more affordable for all, including the unbanked population and micro, small, medium enterprises segment that are less familiar with financial and technology. And then, however, the same time, digitalization also implies a new dimension of risk, including the new type of fraud. So the shadow banking activities, contentious dispute on fraud liability, lack of redress regulation, and then misuse of customer data. For this reason, we as regulator need to take a step so that the ongoing digitalization could have a positive impact on the economy. And on the other hand, the risks that may emerge could be properly mitigated. We in Bank Indonesia are of the view that striking the right balance is needed. The balanced approach between encouraging innovation and mitigating risk need to be done carefully in the right proportion. Distinguished speaker, ladies and gentlemen, the balanced approach is articulated by Bank Indonesia in the form of Indonesian Payment System Blueprint 2025. The blueprint consists of 5 visions, which are the integration of digital economic finance in assuring the proper functioning of the central bank mandate. And then achieves that goal, we need encourage the digitalization of banking and industries so that bank remain the main institution in the digital era. And then we facilitate the interlink between bank and fintechs through API, application programming interface, standardization to tackle shadow banking risk. We also pay attention to the balance between innovation and financial stability, including mitigating cyber risk. And last but not least, the vision will ensure national interest in the cross-border digital economics and finance. The implementation stages of the DUS blueprint is cascaded into 5 main initiatives. The first initiative is to facilitate the interlink between bank and fintechs. This initiative will be achieved through an open API standardization. The second initiative is strengthening the retail payment system. This initiative will be achieved through the development we call BI Fast infrastructure that support the availability of 24 and 7-day real-time, seamless, and secure payment services. The third initiative is strengthening the financial market infrastructure, or FMI. This is very, very important. This initiative will be achieved through modernizing the infrastructure and strengthening the regulatory framework from the FMI. Next, the fourth initiative is developing public infrastructure data for the data. This initiative will be achieved through the provision of payment data hub and digital payment ID. And last but not least, we will also reform our regulatory, licensing, and supervisory approach. This initiative will be achieved by the new paradigm of regulation, which is a principle-based approach, as well as bundling licensing regime. All those initiatives are conducted through collaborative approach involving not only Bank Indonesia, but also related authorities and the all payment system provider. Distinguished speaker, ladies and gentlemen, before being explained in more detail by speaker, I would like to take this opportunity to highlight some initiatives that are in line with today's topic of discussion, which are the role of fintech, data, and regulatory technology. Regarding the role of fintech, as we all know, fintech has grown rapidly in recent years and are likely to continue growing in the near future, driven by technological advancement, changing customer expectation, availability of funding, and also increasing support from government and regulator. In this context, we see that fintech could play a bigger role for the economic through collaborative with the bank. The collaboration with the bank and fintech is expected to provide wider payment and financial services that could reach throughout the nation. Banks, which have strong and ample liquidity now, need to channel the financing to real sector and serve the economic activities by providing payment services. In other hand, fintechs is more agile than bank. Is seen as being able to better reach Indonesian people who are spread across thousands of islands. Therefore, the first initiative that I mentioned before, with its interlink between bank and fintech, become relevant and important. The initiative allows banks to open their customer financial data and information to third parties, fintech, and also require similar openness on the fintech side. The interlink between bank and fintech will also maintain the level of playing field between bank and fintechs, prevent monopoly risk, and widen the opportunity for inclusiveness from the acquisition of more extensive granular data. The interlink between bank and fintech, we also maintain the level of playing field between bank and fintech, prevent monopoly risk, and widen the opportunity for inclusiveness from the acquisition of more extensive granular data. Data is public good that should not be monopolized by one or certain institution. Therefore, we are planning to build an infrastructure for the payment data hub that absorb all payment data across the wholesale and retail payment infrastructure in Indonesia. The payment data hub will process the data and return the output to the industry, which can be used to increase innovation and encourage inclusivity. For example, the payment data hub will create a payment scoring model that could serve as a basis to finance the unbanked people so that it could promote inclusiveness. After all payment data could be absorbed through payment data hub, then we as regulator could transform into a data-driven institution with high analytic capability. This is important for the monetary policy, transmission for the monetary policy. Supported by digitalization of our internal business process now and also international standard information system that are currently being built. We will transform our policy and decision-making process into digital-based policy and decision-making process. We call this initiative Bank Indonesia Omni Experience. In addition, the use of the granular data from the payment data hub, also all other data sources, as well as digital-based approach in the policy and decision-making process, are the characteristic of the implementation of regulatory technology in Bank Indonesia. I think I need to stop my keynote here. I'm glad to know that all today participants are coming from many backgrounds. I would suggest you to take benefit of this webinar by actively participate in discussion with the prominent speaker. I would also encourage all of you to take advantage of this event as means for the networking, knowledge sharing, since the participants of this webinar come from diverse background, from policymaker, industry to academician. To conclude, on behalf of Bank Indonesia, I would like to convey our appreciation to all participants for taking part in this strategic webinar and sending our sincere gratitude to all speakers and panelists for sharing their expertise and valuable insight. And I think thank you, and I have insightful webinar this afternoon. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Mr. Doni, for such interesting view on how central bank grasp the digital transformation and have some initiative to catch up about how you manage, like the central bank manage the digital transformation to keep up to boost the financial performance. Because as mentioned by Mr. Doni, that the digital transformation somehow changed on the digital, the financial landscape of how we conduct the economy itself. I think it could be very nice if we directly heard how the Indonesian Deposit Insurance also see how the theme today, the financial development and also digital transformation and economic uncertainty, and how the Indonesian Deposit Insurance Corporation grasps and do initiative regarding the theme of today. And proudly brought to you the member of Board Commissioner, Indonesia Deposit Insurance Corporation LPS, Mr. Didik Madiyono. Good evening, Pak Didik. Good evening, Pak Didik. It's good to see you.
Okay,
so please, sir.
Thank you. Okay. The Honorable Professor Dr. Jamal Wimboh, Rector of the University 11 Maret, Professor Dr. Wimboh Santoso, Chairman of the Indonesian Financial Services Authority, OJK, Mr. Doni P. Joewono, Deputy Governor of Bank Indonesia, Professor Dr. Sajidan, Professor Dr. Kuncoro Diarjo, Professor Dr. Ahmad Yunus, and Professor Dr. Bandi, Vice Rector of the University of 11 Maret, Professor Dr. Joko Suharjanto, Dean of Faculty Economic and Business, University of 11 Maret, Dr. Erwan Trinugroho, Head of Banking and Fintech Center, University of 11 Maret, all distinguished speakers in this session, and all the seminar participation. Assalamualaikum warahmatullahi wabarakatuh. Om Swastiastu, Namo Buddhaya, prosperous and virtuous regards to all of you. First of all, let us praise Allah Subhanahu wa Ta'ala, God the Almighty, who has blessed us with generous mercies and blessing, so that we can attend and greet each other in this excellent webinar. Secondly, I would like to convey my utmost appreciation to Professor Jamal Wimboh, Rector of the University 11 Maret, for initiating this great event and inviting me as one of keynote speakers representing of Indonesian Deposit Insurance Corporation, IDIC, Lembaga Penjamin Simpanan, LPS. I would like also to congratulate to Dr. Nugroho at University of 11 Maret Center of Fintech and Banking on this excellent achievement for organizing this event. This international seminar on financial development, digital transformation, and economic uncertainty certainly has a very important meaning to all of us. I believe that this event will be able to provide plenty new insight to all of us on what are important things that we need to concern in order to recover the Indonesian economic strongly from the COVID-19 pandemic. Ladies and gentlemen, it has been a year since the COVID-19 pandemic hit Indonesia. This pandemic has hit almost all aspects of every country's economy, including Indonesia. However, much progress has been made through concerted effort of the government around the world to curb the pandemic, including mass social restriction or lockdown in several countries, as well as intensive vaccine development. Major international organizations such as IMF, World Bank, and OECD has projected a better global economic growth in 2021. In particular, the IMF project the global economic growth in 2021 will be at 5.5% and World Bank at 4%, while OECD at 5.6%. Aligned with the global recovery, the Indonesian economy is projected to grow by 4.8% in 2021 by the IMF. Meanwhile, World Bank project it to be around 4.4%. A surprising positive outlook revision comes from OECD, which recently increased its projection to the Indonesia economic growth from 4.0% to 4.9%. On its previous outlook, OECD tends to be relatively less optimistic than IMF and World Bank. This has shown the optimism of global economy recovery to 2021 from the pandemic. However, some market volatilities might still loom, and the level of economic recovery might vary between countries, which will greatly depend on the success of each country in overcoming the pandemic, including the effectiveness of distributing vaccine to the public and handling the new strain of COVID-19 viruses. Ladies and gentlemen, the COVID-19 pandemic not only has an impact on the economy, but also the shifting of consumer behavior towards digital-based services. In Southeast Asia, around 1 in 3, around 36% of consumers using digital services were new consumers during the pandemic. About 9 out of 10 consumers who use the new digital services will continue to use the services in the future. While having a negative full-year economic growth in 2020, Indonesia internet-based economy has been able to grow in double digits at 11% of gross market value in 2020. This growth rate is just second in Southeast Asia after Vietnam, which has been able to grow by 16% in 2020. As the pandemic increases consumer dependency on digital-based services immensely, the World Bank, Google, Temasek, Bain and Company called this phenomenon as the flight to digital in their recent research report. With the development of computerized technology and digitalization, the banking business model also continues to evolve. This technological development will lead to more efficient banking, better customer services, and a higher contribution to the economy. Despite the hype of going digital, we need to anticipate and remain vigilant to the potential risks and challenges that will be faced in the short, medium, and the long term. According to World Economic Forum Global Risk Perception Survey in 2020, One of the most imminent threats includes digital inequality and is also the highest likelihood risk on the next 10 years, along with digital power concentration and cybersecurity failure. In the long run, we need to be prepared for adverse effect of technology. Therefore, we need to prepare adequate risk treatment plan in order to minimize the impact of this potential risk that may arise. Ladies and gentlemen, in order to ensure financial system stability, including maintaining public trust in the banking system, prudent and effective risk management practices by bank, as well as synergistic collaboration among members of the financial safety net coordinated by the Financial System Stability Committee (KSSK) are critical. The financial safety net aims to ensure the stability of the national financial system amidst uncertainties and economic disruption. The Indonesia Deposit Insurance Corporation (IDIC), as the third layer of the financial safety net, plays a pivotal role in providing credible deposit insurance scheme and effective bank resolution. The IDIC carries out its mandate and function in accordance with international best practices. All banks in Indonesia are members of the Deposit Insurance Program, whether they are commercial banks or rural banks. The maximum amount of deposit insured by the IDIC is 2 billion rupiah per depositor per bank, and depositors need to ensure compliance with the deposit insurance requirement, which so-called the 3 rule of eligible deposit or 3T, which include being recorded in the bank's book, having deposit rate not exceeding the maximum deposit insurance rate, and not contributing to the failure of the bank. In the midst of the COVID-19 pandemic, the performance of Indonesian banking sector remains stable and robust. In particular, in January 2021, capital adequacy ratio remains strong at 24.5%, while non-performing loan ratio, NPL ratio, is still relatively at a manageable level at 3.17%. This shows that OJK policy of credit restructuring program has been successfully helping banks to manage their credit risk well. According to OJK, the accumulative realization of bank loan structuring as of February 2021 has reached 987 trillion for 7.9 million debtors. Even though the amount is quite large, the restructured loans at risk is still much lower than expectation. Currently, its level is relatively flat, and some debtors are starting to recover. Meanwhile, in terms of liquidity, the banking industry has sufficiently ample liquidity, as shown by the deposit growth of 10.57% in January 2021. However, bank credit growth is still contracted at minus 1.92% in January 2021 due to the demand pool that's still recovering. Ladies and gentlemen, during the last 2 decades, IDIC has experienced evolving roles. When it was first established through Law Number 24 of 2004, IDIC had a mandate as PEPOC Plus to conduct deposit insurance and limited bank resolution functions. Reflecting to the experience of facing the global financial crisis in 2008, IDIC mandate was then strengthened by Law Number 9, 2016 to become a loss minimizer, which expanded bank resolution function by adding other resolution options, such as purchase and assumption and disbank. Lastly, in 2020, IDIC mandate has been further expanded to become a risk minimizer by Law Number 2, 2020, in a concerted effort to handle the COVID-19 pandemic and or to face potential threat to the national economy and our financial system stability. With this mandate, IDIC able to conduct early intervention for handling severe trouble banks before becoming failed banks. We call it pre-resolution. Furthermore, bank resolution is not only subject to the least cost analysis, but also based on other considerations such as economic condition, complexity of bank problems, time needed to do resolution, availability of investor, and or effectiveness of handling bank problems. In addition, according to Government Regulation Number 33 of 2020, IDIC also has authority to place funds in banks during the economic recovery from the impacts of COVID-19 to strengthen IDIC liquidity and or to anticipate of solve financial system problem that may lead to bank failure. As of January 2021, IDIC has insured most of bank accounts, keeping bank deposit to grow steadily. In more detailed data, the number of accounts insured by IDIC is 1990.92%, or equal to 352,430,068 accounts. Meanwhile, the amount of deposit insured is around 52.38%, or equal to 3,477.75 trillion rupiah. According to the rule of thumb introduced by the International Association of Deposit Insurers, IID, the deposit insurance at least cover 80% of total depositor and 20 until 30% of total deposit amount. Based on law number 24 of 2004, IDIC was given the mandate to insure at least 90% of total depositors in the banking industry. Measure related to the income level, based on academic paper by Dominican et al. In 2015, the average ratio of deposit cover per GDP per capita is around 5 times in high income countries, around 6 times in upper middle income countries, around 11 times in lower middle income countries, and around 5 times in low income countries. In Indonesia, since October 2008, IDIC has increased its coverage from 100 million rupiah per depositor per bank to 2 billion per depositor per bank, which is equivalent to 35.1 times GDP per capita in 2020. Compared to the international standard that I have mentioned before, this ratio is much higher. We saw that IDIC has highly committed to maintain the trust of depositors, make them feel more secure, safe, and rest assured in saving their deposit in the banking industry. Ladies and gentlemen, IDIC along with BI and OJK have actively implemented various policy response in order to support national economic recovery. BI has implemented several policies, including BI 7-day reverse repo rate cut, relaxation of down payment requirement by automotive loans and housing loan. OJK has implemented relaxation of credit assessment and credit restructuring to debtors who are affected by COVID-19, allowing merger, consolidation, acquisition, and integration to the bank permitted by OJK, and risk-weighted asset reduction for residential house-backed credit, and also risk-weighted asset for automated loans. IDIC has implemented deposit insurance rate cut that aim to reduce bank cost of fund, penalty relaxation of late premium payment, and relaxation of report submission by bank. In particular, through 2020, IDIC has reduced its maximum deposit insurance rate by 150 basis points for Indonesian ADR deposit and in commercial bank and rural banks, as well as 75 basis points for foreign denominated deposit in commercial bank. In February 2021, IDIC has reduced its maximum guarantee rate by 20% for IDR deposit in commercial and rural bank, as well as foreign denominated deposit in commercial bank. Currently, the IDIC deposit insurance rate for ADR deposit are 4.25% and 6.75% for commercial bank and rural bank respectively, while the deposit insurance for rate for commercial bank foreign denominated deposit is 0.75%. Ladies and gentlemen, during the digital era, the asymmetric information doesn't occur because the lack of information, like what we have learned in the traditional banking literature started by a seminar paper of Leland and Pyle in 1977. Instead, the asymmetric information problem in today's era is mainly due to overwhelmingly noises and biases, the information availability to the public, especially through the social media. Therefore, effective public communication of deposit insurance scheme to the society become utmost important, especially given the fact that financial literacy in Indonesia is still relatively low compared to other countries. Accordingly, IDIC has been intensively socialized its mandate and expansion as well as deposit insurance scheme and policies through 1. Collaboration with various stakeholders, including the media in various forms of public education to maintain trust in the banking system. The second one, publication on various communication channels, including social media, to increase positive public sentiment and to prevent hoaxes. Ladies and gentlemen, to conclude, I would like to reinstate the depositor trust to the banking industry is utmost important to IDIC, and therefore we provide deposit insurance program with such a high standard according to international best practices. To fulfill this purpose, of course, synergy and support are most needed from all stakeholders, including our fellow regulators, bankers, and also academia. Finally, let's hope that this pandemic will soon be over, and together we support the economic recovery program to revive our economy and continue the development of our beloved nation for the higher prosperity and well-being of our Indonesian citizens. Please enjoy the food of thoughts provided by the excellent seminar, and I wish for fruitful and productive discussion for all of participants. My warm regards and thank you for the organizer, assistant guest speaker, and all the participants. May Allah always bless of us. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Mr. Didik Madiyono, as a member of Board of Commissioner Indonesia Deposit Insurance Corporation, for give us a light on how the IDIC as a third layer of Indonesian financial safety net addressing the COVID-19 pandemic and also maintaining the public trust in the Indonesian banking industry with some of initiatives such as the cut of this deposit insurance by a certain number, and then the relaxation of the penalty on a late premium, and then relaxation of the report submission. I'm quite interested, and I'm pretty sure that a lot of participants also have a lot of in mind. So I think two of the regulator as a part of Indonesian Financial Safety Net Authority already given the point of view on how the regulator see the financial development and also the digital transformation along the economic uncertainty that we face nowadays. And I think it's time to us to invite the representative of the Indonesian Financial Service Authority. Let me bring up to you the Deputy Commissioner of the OJK Institute and Digital Finance Innovation Indonesian Financial Service Authority, Mr. Imansyah. Very good evening, Mr. Imansyah.
Thank you, moderator.
Platform is yours, sir.
Thank you. Distinguished Mr. Doni P. Joewono, Deputy Governor of Bank Indonesia, Mr. Didik Madiyono, Member of Commissioner of the Indonesian Deposit Insurance Corporations, Lembaga Penjamin Simpanan, Honorable Professor Jamal Wimboh, Rector of 11 Maret University, honorable speakers, Dr. Supriyanto, President Director of Bank Jateng, Professor John Goodell, University of Akron, USA, Professor Haitian Lu, Hong Kong Polytechnic University, Professor Muckley, University College Dublin, Ireland, Professor David Lee, Singapore University of Social Science, Mr. Wong Yong, Universiti Tungku Abdul Rahman, Malaysia, Dr. Putra Pamungkas, Universiti 11 Maret, Surakarta. So, esteemed colleagues, participants, ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. Good evening, and to some of you, a very good morning as well. First of all, on behalf of Professor Wimboh Santoso, I would like to extend his apology for not being able to deliver his speech personally. So I would like to use this opportunity as well to extend our appreciations to University of 11 Maret Surakarta as the initiator of this great forum, theme financial development, digital transformation, and economic uncertainty. To my view, it is a good event, although I don't have the answer when you're talking about this trilemma, talking about financial development, as well as at the same time, we're talking about digital transformations and economic uncertainty. But on this valuable opportunity, I will allow me to bring 3 points that can be part of the discussions later on. First, I would like to share the sign of the recovery, in particular for Indonesian economy. Second is unlocking the Indonesian digital opportunity in the middle of economic uncertainty. And the third one is the RGK policies. Is very very special, very specific issues on how we are accelerating digital transformation in the financial sector here in Indonesia. Distinguished speakers and participants of the seminar, it has been highlighted by the previous keynote speaker about the pandemic, about the COVID-19 being the situation now occur globally, and I think each country have implemented the social distance measures that halted economic activities to some extent, and it is for sure affecting the global economy as well, and for sure it's also affecting how is the real sector right now. So I think it's very common today, globally as well as in Indonesia, that government thinking about how to do the best effort for economic recovery in its country. But we can see, I think government has set up as well a lot of initiatives. In particular for Indonesia, we have this Indonesian National Economic Program, Recovery Program. Since 2020, government very much committed with the incentives, with the fiscal incentives, and the central bank also with the monetary policy, as well as ourselves from the financial sector supervisors to come up with the relevant regulations and policies that supporting all of the Indonesian government programs. So as of today, we can see that the sign of economic recovery are clearly in horizon already, although it's still a lot of challenges there, but we can see a lot of indicators showing us a betterment in something with the real with the economy in the terms of in the area of macro perspective. We can see that the GDP is improving since third quarter of 2020, and we are expecting that it can grow to 4.5 up to 5.3% year on year. This into 2021. Consumer confidence index in February this year is 85.8, which is slightly increased from January to last month. Retail sales index also increases from negative 4.3% in January to negative 0.7% month to month in February. Indonesian manufacturing PMI in expansion zone as well. Car and motorcycles sales increased in the third quarter of 2020 and still in the expansion zone. And I think with the latest policies regarding the how is government mentions or stipulate regulate the incentives, the tax incentives for the car sales, I think there will be a more robust increase in terms of the car and motorcycle sales in the coming month. And in the capital market in particular, market confidence has been substantially improved with the index is bouncing back to the level of 60,000 level, and the number of retail investor and retail transaction continues to increase. So it's a lot of signs, indicators that we can see that the economy is improving. But although we can see as well, in particular with the financial sector, the capital adequacy ratio of the bank still high. I think it's mentioned by Mr. Didik Madiyono. The liquidity is quite ample. So the capacity for lending is there. But the problem is with the real sector, how you are creating the demand from the real sector. That's really the issue. So I think the government, OJK, and also Bank Indonesia and also LPS, as the member of the Financial Stability Committee here in Indonesia, I think it's very hard to find better efforts for supporting the government overall for the economic recovery in the upcoming months. Given that with the very current situations, when we can see in particular with the development from the global market, particularly with the US market, then I think it's an issue of the readiness of ourselves as well to anticipate the unprecedented consequences coming from the global market, in particular with the US market today. Distinguished speakers and participants, despite of the sign of economic recovery I mentioned before, there is a high level of uncertainty surrounding the pace of economic growth in 2021. I think this is very common that everybody knows about what happened now within the US. But anyway, everybody thinking about how to be ready for taking a particular and very special initiatives to overcome the unintended consequences from the global market. On the other hand, we can see that the digital transformation is not a new thing. I think everybody agree with me. However, the COVID-19 pandemic is the perfect momentum to accelerate the digital transformation. Given a lot of survey is proven, is confirmed that COVID-19 is just like, a game changer for everybody to move even faster for the digital transformation. Not only, in daily activities, but also I think ourselves in the financial sector do realize about these transformations. And Indonesia in particular, as an archipelago, has enormous potential to develop digital economy. We agree with some reports that more than 190 million people, or 71% of the total populations, are in the productive age with annual total population growth of 1.25%. 150 million people are in the middle income class. 64 million micro as small medium enterprises are in the market, and they are contributing significantly to the economy. 196.7 million people of the populations are connected to the internet, and I think there's also a continuous growth of e-commerce in Indonesia, reaching 54% throughout 2020, despite a decline in travel and transformation sector. It is clear to see that there will be no point of return to normal, right? Because of this COVID-19. So everybody has becoming, it is permanently reshaping the way customer doing activity, including in financial sector. In this regard, financial institutions in Indonesia also need to accelerate their digital transformation to fulfill the consumer needs. To accelerate the digital transformations in financial services, ourselves will promote the cross-industry collaborations and leverage innovation, especially on financial services and products. And this collaboration and innovation will generate low pricing financial product and services and open financial access to unbanked population. So we try to resolve the situations where we're being challenged by the quite high net interest margin, considered as not really efficient financial industry in the region, and as well as the still low of literacy and low of financial inclusion as well here in the region. So we try to get better conditions of those issues in the future. Further, we also believe that the digital transformation in financial sector will be the game changer to the financial sector landscape, including how we can improve the customer experience by delivering better quality, efficient and right on-target financial product and services. Financial sector from the beginning must think about how they are shifting their mindset from product-centric to customer-centric. It's a big challenge actually for everybody in the financial sector. The other one is how to increase the competitiveness among themselves, but not only in domestic market, but also how we can compete into the global market. So this is also something that how we can attract, player from other countries to also install or take some part of the digital transformation here in Indonesia, both for the business processes and provision of digital financial product and services as well. Increase financial inclusions, I mentioned this before, by serving underserved population in Indonesia and people in remote areas. We have things mentioned by Mr. Doni Pejuan. We have like a 17,000 island. It's something that you can fly 8 hours from the edge of the very eastern of Indonesia to the very western part of Indonesia. So it's a big country, and we have a lot of people that living in the remote areas, being unconnected by infrastructure. So I think by digitalization is also another way to being more connected between people in a lot of areas here in Indonesia. Distinguished speakers and participants, I think despite the benefits I mentioned previously, the digital transformation also brings some challenges. I think it's normally two sides of one coin, right? So I think a lot of challenges also being in the financial sector. Cybersecurity is one. The leading challenge for digital adoption, which could lead to data protection violations. It happened a lot that undue use of this data by people that not really in charge or responsible for this managing the data. To mitigate data protection and cyber risk, the regulators need to balance safety and customer convenience by developing the robust risk management. So when you're talking about risk management, speakers and as well as participants, we do have the regulation on risk management, but we don't yet regulate how we are calibrating the cyber risk into the risk management framework. So I think will be this part of the operational risk. So it can be standalone type of risk, or we have to calibrate alone. So then people becoming more aware of this type of risk, or it's just part of the operational risk. We haven't yet any regulation that touched that area as of today. So I think it's also another challenge for ourselves in future, how we can tackle the issue of cyber risk and our financial sector becoming more aware with the cyber risk. It's not easy because we have again, the issue of capacity building is there, the issue of infrastructure is there. So a lot of areas that we have to develop before we come to the better regulations on how we see the cyber risk in our financial sector. But anyway, OJK last January, in terms of how we are thinking about the future of financial sector in Indonesia, OJK has published the policy directions for digital transformation. It is part of what we call Indonesia Financial Services Master Plan 2020-2025, and we do have as well OJK Digital Finance Innovation Roadmap and Action Plan 2020 and 2024. So with these two initiatives, with these two public documents, it is part of our mandate to become more transparent to the industry, to the public, how we are managing the future of our digital finance ecosystem. As part of our initiative to create a financial service industry that is competitive, resilient to change, and fit for the future. So I would like to speakers and also participants, I would like to highlight, I think, 5 areas that really related to what I mentioned before with the our public documents with regard to the master plan as well as the digital innovation plan. First is we very much try to encourage the rapid and massive implementations of digital transformation in financial sector, as digital transformation leads to agile, adaptive, and competitive financial service institution. In this regard, we established already what we call the Sandbox Center. We have this what we call OJK Infinity. Stands for OJK Innovation Center for Digital Financial, and this is a sandbox. So everybody having innovation in the financial sector, they can submit to us, and we are doing assessment within our regulatory sandbox to see and to exercise the business model and how robust is the risk management. How ready is the management, and how good is the quality of the capital, and all those things will be exercised, will be assessed within our regulated sandbox. For sure, we have like a 16th cluster of these digital financial innovation within ourselves, within the OJK. Then the second one is reassuring the development of infrastructure and regulations to uphold the digital financial sector ecosystem by constructing the synergy between financial service institutions and technology-based companies. I think it's a given idea that this will accelerate the development of infrastructure on new technologies for the financial service sector. The third one is a roadmap that complements financial institution strategies by also including as well and empowering at the same time the micro, small, and medium enterprises. So because I mentioned before, the micro, medium, and small enterprises is the big part of the player in our economy. So I think when we support them, it will also support our economic recovery. OJK also developed digital financial inclusions, strategy, and literacy. So we are building like applications, and we put in the Apple Store, and also then everybody can use this type of tools to increase their understanding about the financial sector as well as the digital financial innovation, as well as at the same time we try to promote and also to have the educate customer protection in place. The fourth one is leveraging the human resources capacity and talent on digital field in the financial sector. So it is something we're talking about certification program. So we do have we are running out of the people that having a good capacity in terms of technology. So it's an enabler for us in the future. We still have resources to support us in how we tackle the issue in in the digitalizations of independent financial services sector. And the last one is actually ourselves. We try to implement. We're accelerating the implementations of IT-based supervisions and RegTech or SupTech and RegTech based on big data analytics. And also, I think as early detections of any vulnerables in the financial sector due to adoptions of these digital transformations. So, distinguished speakers and participants, I don't want to take your time too long. So, I think it's a good opportunity that we can go further with the presentations by the prominent speakers. That is what I can convey on behalf of the chairman of the OJK, Professor Wimboh Santoso. Hopefully, this event we have tonight can be a way to answer the questions on how we have this. At the same time, we have this financial development. We have also the digital transformation and the economic uncertainty, and we hope at the end we can have a betterment conditions of economic recovery, not only in Indonesia but also globally. So again, our appreciations to all speakers, to the committees, to the 11 Maret University for inviting OJK in this event. Have a great discussions, and hopefully we have utmost benefit from this event. Thank you very much for your kind attentions. And I conclude here. I close my speech. Assalamualaikum warahmatullahi wabarakatuh. And back to moderator. Thank you very much.
Thank you very much, for the delivery on how the OJK addressing the digital transformation. And Mr. Imansyah already mentioned about a lot of things regarding the OJK policy on how addressing digital transformation, and also how to see that the digital transformation not only bring the opportunity but also bring up the risk that need to be tackled and be prepared by another regulator also. And the three keynote speech already delivered to us on how digital transformation could be the game changer and like a differentiate more or less the condition of the financial industry landscape. And I think it's also time for us to, without further ado, come to the plenary session. There are 7 notable speakers that already prepare, I'm pretty sure, a very interesting and shedding a light on how the we addressing the financial development and also the digital transformation and also the economic uncertainty. And I think without further ado, let's meet our first speakers. I hope you do not mind if we kind of little bit change the sequence, because some of the speaker already have the another agenda. So Prof. Goodell, are you with us now?
I sure am. Thank you.
Do you mind?
Thanks for accommodating me. Yeah.
Okay. So I think I should give the opportunity to you first, because you have another agenda in our
I have to switch over and do a webinar for Elsevier in a half hour or so. So it's very kind of you. Here, let me start sharing here.
So Professor John Goodell, ladies and gentlemen, he is a professor of the Department of Finance at the University of Akron, and his research interests focus particularly on the impact of financial system of national culture and institution. In 2011, he received the Stockholm School of Economics Women in Academy of International Business Award. He also for increasing the gender awareness in international businesses. Professor John Goodell, also editor-in-chief of Research in International Business Finance. So, Prof. John, platform is yours.
Oh, thanks so much. Appreciate it. It's great to be here. Hello, everyone at UNS, and of course, hello to all the distinguished speakers and guests, and a special hello to my friend Erwan, who is always such a delight to collaborate with. An unusual topic, perhaps a bit of a boutique or niche topic, but I'd like to talk a little bit about the cryptocurrency Tether and its conflict with the new emerging Chinese sovereign digital currency. You might say sovereign cryptocurrency, which I think has a lot of unknown possibilities for the coming year. And it has been indeed a past year of great disruptions with perhaps long-term changes in the financial systems, mainly due to COVID, but who knows, maybe there's a few other possibilities. Reappraisal of equity risks, changes in the values of certain industries. We even saw last year a momentary drop in oil prices to negative values. So it's been a crazy year, and much of that's attributed to COVID. But there are some crazy other things, especially perhaps the gradual rollout of China's digital currency DCEP, which would, I think many of you are already aware, is China's converting the RMB or the yuan to a blockchain-based type of cryptocurrency. And commentators are looking towards a rather extensive battle, if you will, I'm not sure that's the right word, between the US dollar system and the Chinese national currency system, with competing international payment systems and so on. And some commentators have even suggested that if years later we might look back on 2020 and say there were two significant events, COVID-19 and the introduction of blockchain-based sovereign currencies. But that remains to be seen. But what is Tether, and what's this have to do with anything regarding this? Tether is a cryptocurrency with a value mirroring the US dollar. I'm guessing most of you are familiar with this. It would be difficult to fit all these sort of technical explanations into one talk. So Tether is what they call a stable coin. And it sort of maps the US dollar 1-to-1, although for those that are more deeply interested in cryptocurrencies, sometimes that mapping 1-to-1 with the US dollar isn't quite so, and there's been some lawsuits and so on, but that's maybe for a different conversation and a different day. But there seems to be evidence around the world that Tether in many ways can substitute in a lot of contexts for the US dollar. And along with this is that even though it is not particularly lawful to use Chinese yuan or RMB to purchase Tether, it occurs a lot. And Tether is seen as being traded even more than Bitcoin, with about 2/3 of those trades and purchases being done by Chinese citizens. And it's also seen that there may be a lot of uses out there for Tether. And it's also seen that the Chinese government is not particularly keen on its citizens using Tether, especially with the rollout of their digital sovereign currency. And so there's conflict that I think will occur in 2021. There's a number of academic papers that have already identified that the cryptocurrency Tether acts rather differently from other currencies, probably because of its stable coin quality. But there are other aspects. Tether is a vehicle for easy purchase of Bitcoin. It's easier if you have Tether in the system for yourself to purchase Bitcoin with Tether than it is to purchase with US dollars. And this may be true especially for citizens of China. I'd like to just tap into a few diagrams from a recent work in progress that I'm doing with a colleague of mine, Stéphane Goutet, who's at the University of Paris. And we started off some months ago now, looking at how cryptocurrencies are co-moving with equity indices during COVID-19. A natural topic. There's, of course, a huge amount of interest around the world in portfolio diversification, possible use of cryptocurrencies as safe havens during market turmoil, and so on. Of course, these COVID papers end up evolving because we started working on this months ago, and by the time we have an opportunity to revise our paper for a possible journal, we have double the amount of data now because COVID has continued long past maybe most of our predictions when we started the paper. So a definite work in progress. And what we're doing now with it is we've identified some strange behavior of Tether that's very different from other cryptocurrencies. And we have enough data now to have, say, a year or more's worth of values prior to COVID, and then a year's values during COVID through February of this year. And we find that Tether is strikingly separate from other cryptocurrencies. And this is especially true during the COVID time, that most cryptocurrencies really are not that connected to equity indices, at least in our analysis, but Tether is. And there's a striking amount of spillover from between the S&P and Tether during every COVID wave, and a lot of evidence that Tether, from a portfolio diversification point of view, might be a safe haven. This is probably unreadable for our audience, but there's a little row in there that says Tether amongst we list our different equity indices, which we've somewhat reduced here in this diagram, and several cryptocurrencies, Bitcoin, Litecoin, Ethereum, and Tether, And if you were to be able to read it there, it might be unreadable. You might see that the row for Tether has a lot of negative numbers in it, in this heat map, suggesting that possibly Tether is somewhat of a safe haven for equity investors during market turmoil. In this graph, again, I'm not trying to get into the technical details of this working paper. I think that wouldn't be quite appropriate for today, but a few more graphs. This graph might be also a little bit difficult to read, but it's basically showing rather huge spikes of spillover contagion, if you will, between S&P 500 and Tether that kind of roughly correspond to waves of the COVID. And this might be the best punchline for today. This is just a neural network map. And I think this is quite readable, unlike maybe my other figures, where you can see that Tether is connected to the equity indices, but the other cryptocurrencies really are not. That Tether is really quite separate from the other cryptocurrencies. We find this to be true. This particular neural network map is for the pandemic period. We find this to be true prior to COVID pandemic and during the COVID pandemic, but more so during the COVID time. So as I mentioned, Tether is an on-ramp vehicle for other cryptocurrencies. I think like a lot of us that involve ourselves in cryptocurrencies, perhaps only for the last few years, it's rather new. We rely on a lot of apocryphal information from various cryptocurrency exchanges and traders. We gather information, but it seems to be the case that Tether is commonly used to buy other cryptocurrencies. In fact, that is rather the focus of the most significant cryptocurrency paper, which was published in the Journal of Finance a few years ago, that suggested that Tether is really not tethered at all. It's simply a way of purchasing Bitcoin. Buying currencies, cryptocurrencies directly with the yuan is banned, but overseas US dollar deposits can buy Tether, although the legality of that is gray area for Chinese citizens, and then use Tether to buy other cryptos. And certainly it's been identified that during volatile markets, Tether is purchased to maintain leveraged positions in cryptocurrencies. And there have been some notable cases where it's been identified that Tether has been widely used to wash illegal gambling proceeds. There was a rather well-publicized crackdown last October, I believe. And many see these crackdowns as coinciding with the increasing rollout of China's sovereign digital currency. That, for good reasons or not good reasons, we don't really know, but certainly there's been a great deal of signaling from the Chinese government that they don't want their citizens using Tether. Tether encourages the use of the US dollar. They want to have their citizens involved with the sovereign digital currency, and that they anticipate, market watchers anticipate, this conflict will continue considerably through 2021. And so the questions arise, what is Tether really being used for? Is it really just being used to buy Bitcoin and other cryptocurrencies, or is it being used for large-scale capital flight, capital mobility? And if Tether is suddenly significantly curtailed, because keep in mind 2/3 of those that trade in Tether are Chinese citizens, then what will happen? And then also in terms of my own academic work for this paper, I originally intended a study of what happens to cryptocurrencies and equity indices and their relationship because of COVID. But all the while, there's a hidden effect that's happening, and that is the somewhat unspoken signaling that not to use Tether anymore. And we don't know the degree of the rollout of this DCEP. We know it's widely used as digital money already in major cities, but it's indistinguishable from the user end from digital money on WeChat and so on and so forth. So I see this as perhaps a developing source of instability in 2021, or something that will need to be considered. Of course, the levels that we're talking here are not the same as the levels of the COVID-19 disaster and so on, but there is an estimate that Tether might be involved with perhaps as much as $50 billion in capital flight from Southeast Asia during the last year. So is there something else? See, our results really don't go along with Tether only being used to buy Bitcoin, because otherwise, why would Tether be so separated from the other cryptocurrencies and so much connected to equity indices during the COVID-19 period and generally? And so we feel, we haven't quite proved it, there's many questions that we have, but few answers. But we think that Tether might be actually have evolved into an important part of the international financial system. And given that it's highly likely that Tether will be curtailed over the next year, what will happen there? What will be the consequences? How has the anticipation of the DCEP impacted Tether? How will it further impact it? How will the further development of DCEP change Tether? And if Tether is impeded, how will this affect the ability of the global economy to react to risk? And by the way, I don't have answers for these questions, but I thank you for your time today. Let me stop sharing and turn it back over to Duante.
Thank you very much for Prof. John Goodell for such. I think your presentation give us like a shed light on how the cryptocurrency work and the new, what do we call for the new trend on how Tether finally surpassing Bitcoin and another issue that maybe some of us is not familiar with this thing, but it gives us a new insight on how like the digital transformation itself for now. It's not only it's not only changing on how the financial industry work, but also creating a new financial product that more or less could be beneficial to the whole economy. So thank you very much, Prof. Goodell.
Thank you. Thank you.
And unfortunately, Prof. Goodell cannot following the whole discussion. So have a good day, Prof. And I hope your another agenda will run well also. Thank you very much once again.
And thank you. I'm so sad to have to leave early to do this other commitment. And of course, I really enjoy being a part of the whole event and look forward to future events or hopefully have an opportunity to watch the recording. Thank you.
Thank you very much. It's such a pleasure for us to be your student for today. And let's proceed to the second speaker for the plenary session on the webinar for financial development, digital transformation, and economic uncertainty. Probably bring up to you Professor Carl Muckley. Professor Carl Muckley is an operational risk in banking and finance professor at the UCD College Business and a fellow at the UCD Gary Institute. His research interests are in the interface of the corporation and the capital market with a focus in mitigating financial fraud. Oh, it could be very interesting because nowadays digital transformation is very close to a fraud and some other fraud that only arise due to the digital transformation. And he obtained his PhD degree from the Trinity College Dublin. So he has been a visiting scholar also at the New York University Stern School of Business, Yale University at the Groningen, and Tilburg University in the Netherlands. So without further ado, let's meet Professor Carl Muckley. Good afternoon.
Hello, good afternoon. I hope everybody can hear me clearly.
Yes, perfect.
So look, it's a privilege to be here and to have this opportunity to talk to these communities of our regulators and fintech and bankers, and to share my own research insight into the topic for today's event, financial development, digital transformation, and economic uncertainty.
Okay, Bob.
So
please
maybe I could. Would I push ahead? Is that how I should go? Yes, I guess.
Yes, please, please. Platform is yours.
Absolutely. So I'm going to go and share my screen. I'm going to find the. Let me just open this up here, and then I come back in and share my screen. Okay. Okay, so my screen should be fine now, I guess.
Yeah, we can see it clearly.
Okay, let me know if that changes. Okay. So from a financial development and digital transformation perspective, I'd like to say a few words about my understanding of the Indonesian experience, which frankly, has been certainly brought up to date in the last hour or so during this conference, and thank you very much for that. So, before arriving here today, I was very familiar with Indonesia as having a consistently strong economic growth in recent years, indeed since the great financial crisis, having a striking drop in the last half decade or so in its poverty rate, and as having a strong upward trajectory in terms of economic growth among its G20 peers. So, with all of that as a backdrop, it doesn't surprise me to see the potential for digital innovation in Indonesia. My looking through the literature, the World Bank studies on this topic, and consultancy studies, McKinsey here and Deloitte, indicated up to even as far back as 3 or 4 years ago, huge potential. So I think Deloitte, using World Bank data, highlighted 110 million unbanked, bankable citizens in Indonesia alone, which is absolutely enormous. And I did flick through the Carta post as well as I was kind of tuning into this webinar, and I noticed a lot of celebration of Indonesia as ripe for digital innovation. So it's my job to kind of say, okay, I'm familiar with the huge amount of exciting economic activity, and even the drop in economic inequality, as I pointed out, the drop in the poverty rate. But from this financial development and digital transformation can arise economic uncertainty. Okay, so this is where I'm going to start tuning very much into my own background. So what's the channel that I highlight here with you that interlinks financial innovation and economic uncertainty? Well, I think the channel that strikes me, or an important channel that strikes me, is the channel of financial misconduct, which is well known as a key potential driver of systemic risk. Okay, so systemic risk can arise due to financial misconduct. And financial misconduct is part and parcel, I'm afraid, a risk of financial development and digital innovation. So it's wonderful to see the digital innovation, the financial innovation, the financial development. But at the same time, as you've pointed out in your various keynote talks, there are risks associated with all this development, and they need to be monitored and to be mitigated. So here's a reference to Mark Carney and the Financial Stability Board, and these kind of references occur regularly from globally important regulatory institutions. The possibility of financial misconduct creating systemic risk and introducing economic uncertainty. So what can we do about it? Well, I think I have a little bit of good news and very original research in respect to this issue, or at least one aspect of it. So one type of financial misconduct is clearly the abuse of older people. The abuse of older people. So financial elder abuse. And financial institutions have a moral and a regulatory, increasingly, but certainly a moral duty of care to protect their older customers against financial abuse. Now, financial abuse, how can financial abuse, this type of financial misconduct, how can it produce systemic risk? How can it produce economic uncertainty? Well, here I resonate with some of the points that were raised earlier. And it was highlighted that public trust in banking institutions is vitally important. Public trust in banking institutions is a necessary condition to allow the great potential for growth and the flight to innovation that is before Indonesia at present. So I'm going to focus right in on this particular category of financial misconduct, elder financial exploitation. Now, this is a topic that unfortunately many of us will have had personal experience with, perhaps in our own lives. I would go so far as to say highly likely in the lives of our peers and our relatives. It is a major issue. If I can turn for a moment and look at the Indonesian experience. Now, this is not of elder financial abuse, but rather of the proportion of Indonesian population, which is over the age of 65, is how the World Bank defines the threshold for older people. So we can see here, since the 1990s, the this elder dependence ratio has grown from, in around 6-7%, where it was fairly stable for many years, and really grown quickly until 2020, where it's above 8%. So we're talking about 33% increase in this elder dependence ratio. So more and more people are living longer and longer. So if you look at this elder dependence ratio in Japan now, we're talking about maybe 45% at present. So high. In Ireland, incidentally, it's 25%. But looking at the trajectory in the years ahead, it can be expected that Indonesia is going to see this as a bigger and bigger challenge as more and more people live longer and longer. So a big positive upside of economic development and improved healthcare systems. But a downside, of course, are these people with more wealth and potentially more vulnerable to financial abuse can indeed suffer financial abuse. So it's important, with a view to maintaining trust in the banking system, that financial abuse is mitigated. So this is where I come in really with my research. We've got a couple of kind of technical definitions here, but I know I've got to keep a close eye on the time. So we've got specific definitions of elder financial abuse, but this is where I'd like to. So there is a question, and it's a fundamental fintech question I'd like to draw your attention to here. Can machine learning, a key engine of growth for fintech, can machine learning, can artificial intelligence, can it supplement or even substitute for human expertise? And that's a question we're resonating with here. So the issue is, how can we mitigate elder financial abuse? How can we mitigate this source of misconduct and therefore curtail systemic risk potentialities and economic uncertainty? Well, within financial institutions, we have teams of professional analysts. And the question is that I'm going to raise here with you today is, can we introduce machine learning with a view to supplement or even potentially substitute for some of these experts? So what we've done in our work is we've collaborated with a top US based financial institution, some $7 trillion under management. And we have designed, developed, and implemented an AI system for the better protection of the older customers of this financial institution. So in a sense here, we're bringing new information to the table in respect to the potential of artificial intelligence, machine learning to curtail elder financial abuse, and therefore to curtail this aspect of potential systemic risk and economic uncertainty. And this is a big deal globally, a really important potential driver of systemic risk. And I'm pointing at the high incidence of older persons who suffer elder financial abuse. And we're talking about at least tens of billions of US dollars even lost in the US alone to elder financial abuse. We're talking about the misallocation of capital here. So the regulators are increasingly all over this space, particularly in the US, but also very much in Europe as well. And in this SEC white paper by Stephen Dean, there was kind of a gauntlet thrown down, whereby there was a question: can AI detect, prevent, and even predict financial abuse and therefore mitigate it? So we had a very serious go at that question in recent years, and this is our publication in a journal, the European Journal of Finance. Can alert models, can AI for fraud protection better protect the elderly clients of a financial institution? So I'm going to try to give you our principal insight from all of this. Our principal insight is that the impact of the research, we now show that machine learning, artificial intelligence, together with standard bank data, can better protect the older clients of even a top financial institution. So that's a very new insight. It's the potential is there to use all this data that Indonesian institutions and agents are developing and storing with a view to better protecting some of the most vulnerable in the population and therefore mitigating this source of financial misconduct. So how do we get this? I'm going to move ahead here. I realize the time is moving on. I've got to be sensitive to that. In our work, we had data in respect to more than 5 million individuals over 70. So it's a massive financial institution. Some 24 months of transaction level data. And the issue with all of this data is that there was 99.4% false positives of elder financial abuse in it. So we turned, and we using AI, machine learning techniques, which I won't drill down into here unless there's a Q&A and people would like me to a little bit. Critically, there was a drop of 57% in the false positives, while maintaining 90% of the actual instances of financial abuse were actually identified by AI. So the big point here is that the team of professional, highly sophisticated financial analysts within the institution was actually very ably supplemented and even substituted in important ways for using machine learning. So that's a great way, I think, to curtail the exposure of the institution and wider society to elder financial abuse. So, in this, we've worked hard to develop the skill sets of our teams, of course. And I suppose one big deal we have here, we've been trying to disseminate this, this good news that it is worthwhile investing in AI with a view to mitigating financial misconduct, because it actually really can work. And that's just using standard data and quite standard machine learning techniques as well. Ultimately, were only required to provide an able contribution to the team. So we have our work now commended by Age Action, which is a group that looks out for the well-being of older people. So really a human rights contribution. It's been featured in the Wall Street Journal. It's been licensed in the financial institution, and as we said earlier, it's been published in this European Journal of Finance. So what I'm bringing here today really is financial misconduct is a source of systemic risk due to a compromise of public trust in the banking system. One type of financial misconduct is financial abuse. And remember, the financial institution here has got a real duty of care to protect its customers. And that's becoming increasingly evident in regulation around the world. And the news that I'm trying to impart or share with you here today is that machine learning can actually do a brilliant job on standard data to better protect the older customers of a financial institution, and hence uphold public trust for these institutions, minimize the possibility of systemic risk, reduce the possibility of economic uncertainty, and therefore enjoy the upside of financial development, financial innovation, digital innovation, while curtailing this specific downside risk of elder financial exploitation. So I hope that that can be helpful today as part of the discussions. And thank you again for this opportunity to join you and to share this what I think is a bit of good news, really, in terms of curtailing this very challenging and serious downside risk of financial innovation and digital flight. Thank you.
Thank you for Prof. Cal for such I think it's very insightful presentation on how you talk on the theme of the digital transformation, and particularly how you addressing the financial misconduct will be like a source of the systemic risk. And you particularly mention and discussing on what the financial misconduct sources. One of them is the financial exploitation or abuse. Particularly, you're discussing on the elder financial exploitation abuse, and you also underlying and highlighting that artificial intelligence and also machine learning together with the standard bank data can be better protect the elderly clients. So I'm pretty sure, unfortunately, I heard that you cannot following our discussion until the end. So, but I'm pretty sure a lot of participants has raised a lot of questions regarding what you're discussing today. So thank you very much, Professor, for joining with us. And
I hope pleasure. Thank you very much.
Yeah, I hope we can meet again and have a deeper discussion on this issue. Thank you very much once again on behalf of the organizing committee. So ladies and gentlemen, I will also remind you that after the end of the last speaker, Dr. Putra Pamungkas, we will have the question and answer session for 30 minutes. So I would like to humbly invite to all of the participants, if you may have a question, please drop the question in the chat box and I will try to bring up the question to you in the question and answer session. And so let's proceed to the third speaker. The third speaker is Dr. Supriyanto, the President Director of Bank Jateng. He is appointed as the Bank Jateng Managing Director in 2014 to 2017. And he has a background in the banking since 1983, start a banking career at the Bank Dagang Negara at the Staff Division. His educational background, he got the doctoral study in Science and Doctoral Faculty of Economic Programs, Universitas Gadjah Mada. And I think it's such a big pleasure for us to have Dr. Supriyanto because Bank Jateng is one of the prominent regional bank with a lot of achievement, and the latest achievement, if I'm not mistaken, in 2020, it granted as the most innovative regional bank by CNBC Indonesia. So I think it would be a good example on how the regional state bank addressing the digital transformation. So let me greet Dr. Supriyanto.
Good afternoon, ladies and gentlemen. My name is Yudiana, not Mr. Supriyanto.
Yep.
I'm representing Mr. Supriyanto. First of all, I would like to convey the apology from Mr. Supriyanto that he cannot continue this event due to the urgent matter that he needs to tackle. So I would like to share the material from the Mr. Supriyanto, which will share the experience of Bank Jateng to tackle the economic uncertainty and do the digital transformation and try to create a new financial development. Okay, first of all, we would like to introduce who is the Bank Jateng. Bank Jateng is a regional development bank for Central Java, owned by province and district government. Regional Development Bank, or we call it BPD, has a function and a significant role in the context of regional economic development. Growing the local economic development to improve people's lives, provide financing of development finance in the region, in addition to running the business banking as usual. In addition to running the activity of commercial bank, BPD also functions as the cashier of the administration, such as the realization of budget fund and also distributing government and government aid funds. Okay, next slide, please. Okay. How Bank Jateng handle the economic uncertainty? Bank Jateng faced challenges such as the non-performing loan, reducing net interest margin, increasing costs, heightening asset risk, and also reducing demand in some segment. We also see the COVID-19 pandemic also reshape human behavior as the consumer turn to digital channel to meet their financial needs. I will cover this on the next slide. To meet the customer expectation, Bank Jateng do digital transformation to broader customer engagement across the digital channel. So we can conclude that the digital transformation making banking become more important than banks. The area of digital transformation which Bank Jateng did, we focus on the three areas. First, we do digitalization on the service to the customer, which we believe will increase the customer experience. The second one, we digitalize the area of internal operation, which we believe will bring the efficiency for our cost reduction. The third area is digitalization in the area of data-driven, which will give us insight of the customer needs. Next slide, please. Okay, this is coming from the McKinsey survey, which show that the Indonesia customer sentiment during the coronavirus. We see that all customer from Indonesia is already moved to the digital channel at this moment. So around 60% net increase in intent to spend online even post COVID-19. Around 92% of Indonesia consumer have tried to new shopping behavior for the past 3 months. So this will bring us to the conclusion that to meet the customer expectation, the bank must need to do the digital transformation. Please, the next slide. Okay, what kind of digital transformation that Bank Jateng already do so far? First of all, as mentioned earlier, that BPD also function as the cashier administration. This required us to integrate our system with the regional government system, such as car tax system, land tax system, and retribution system. So we create an integrated solution between these two institutions. We also have the host-to-host connection with the hospital system, education, and utility system. In total, so far, we already have 272 host-to-host connection. Now, we also, to reach our rural customer, which we used to call it unbankable, we also deploy around 900 cash agents to capture this, to do the inclusive financial. We also create a collaboration with the Fintech to enlarge scope and service to our customer. So beside our bank's channel, we also do the collaboration with the Fintech to enlarge our channel. Next slide, please. Yeah. So if we can see the evolution of our digital transformation, we begin with previously we only have a distributed system, so not connect between the branches of our office. So the first thing we do is to bring this to centralize, so to bring the 24/7 banking service. Okay. The next level we do is we do the digital connection. We call it a digital banking. So previous slide already show you how we do the connection as much as possible, connection between our bank and the other entity. The next level that we want to achieve is we try to create a digital financial ecosystem. So we will build as many as possible digital-based ecosystem. So I bring two examples on this digital financial ecosystem. Yeah, next slide, please. So the first use case is we call it the SME ecosystem use case. So here BPD, our bank, Bank Jateng, give the SME help to growing their business. So we believe that the SME is the backbone how we will recover our economy. But they need help from us. So we give them the access to financial, access to knowledge, also access to network. For example, by giving the loan very low interest rate to the SME, we believe that we will help them on the financial side. We also give them the training. So we give them the knowledge on how they produce the goods, or how they do the marketing and also logistic system. We also give them the network. We bring them to our network, such as our big customers. So there will be a supply chain supply chain scheme between this SME and the big customer we have. We also give them the working space, so working space for free, so they can do the networking between each other and also networking with the supplier for them. Last but not least, we also provide them with the digital marketplace. We call it BMAT as well. So with this approach, we believe we can help growing the business of the SME so they can get the new, a new platform for them to grow. The other second scenario is in Indonesia, we have a rural bank. We call it the BPR. BPR, like other financial institutions, also need to do the digital transformation, but they are facing the challenge on providing investment to buy a digital solution. As you know, that IT solution is not cheap. From economic scale, they cannot afford to have it. To overcome the situation, we are thinking to leverage our technology for them, so they don't need to buy the platform. We can co-branding what we have at this moment. Through this partnership, Bank Jateng also can get benefit. Bank Jateng can expand the physical network using the PPR office channel. So this kind of development, we already arrived at this point, but we still see that we need help from our regulator. Next slide, please. So actually, this is the support needed coming from regulator, that we considering that regional development bank as the bank that exists in the national banking system has different characteristics with the other bank. The second consideration, establishing of BPD is to encourage the development in the area. BPD is directed to support infrastructure development, SME, agriculture, and other economic activity within the framework of regional development. To this end, BPD needs support from regulator. So, considering those items, we propose to establish regional financial architecture, which will regulate area of focus BPD and state-owned bank. Because at this moment, BPD and the state-owned bank competing each other on the regional. So we propose that BPD focus to the framework of regional development, state-owned bank focus to the framework of national development and international expansion. Without clear segregation, BPD and state-owned bank competing against each other in the region, leading to inefficiency. So through this integrated regulation, we believe that the architecture will enforce the market discipline. So imposing the strong, this market discipline will imposing strong incentive on BPR to conduct their business in efficient manner. I think that's all from our sharing.
Thank you very much, Pak Yudiana. Such a good insight from you that you telling us on about the journey of the digitalization transformation on Bank Jateng and how you, the management of Bank Jateng successfully in grasping and embracing the digital transformation. Meanwhile, probably the other bank is like hardly to accept this one and reluctantly to adopt what we call the digital transformation. But as a Bank Jateng management did, you successfully creating more than 272 host-to-host connection and other collaboration. And surprisingly, as a regional bank that located quite from the capital city, you also embracing the opportunity to collaborate with the financial technology. And I really hope that you can joining us until the end of the question and answer session, because I'm pretty sure a lot of discussion will be arise during the question and answer session. So let's proceed to the fourth speaker for today's webinar. He's a professor in law and finance at the School of Accounting and Finance. He is also the director of Chinese Mainland Affairs Office of Hong Kong Polytechnic University. Prof will contribute to the academic and professional society by serving as associate editor journal of Financial Stability. Without further ado, please welcome Prof. Haitian Lu from Hong Kong Polytechnic University.
Okay, thank you, moderator. Can you see my slide?
Perfect, Prof. So
okay,
please,
thank you.
platform is yours.
Thank you. Okay, distinguished guests, speakers, and audience. Firstly, I would like to express my appreciation for the UNS for inviting me to speak at this important webinar. I learned a lot. Okay, the topic I am contributing today is the lessons from the rise and fall of the peer-to-peer lending in China. So I choose this topic because I think it hits all the three themes: financial development, digital transformation, and economic uncertainty. So I will start with this basic model of peer-to-peer lending. As we all know, this peer-to-peer lending or online marketplace lending is a fintech innovation that appeared in the late 2000s. It is to enable a person-to-person lending by cutting out the financial institution as the middleman. So we call it a de-intermediation. Okay, so the platform is a marketplace, information aggregator, and a matchmaker. And then I'm going to tell you the sad story about the peer-to-peer lending industry in China. The fact is, China used to have the world's largest peer-to-peer lending market, whose size is larger than the rest of the world combined. And before 2015, there is effectively a regulatory vacuum. So there's no law that regulates the peer-to-peer lending. So as a result, there's an enormous number of platforms arising. So by 2018, there were over 6,600 peer-to-peer lending platforms, facilitating a cumulative total of US $1.2 trillion in loans. However, due to the massive platform failure and regulatory crackdowns, the number of operating peer-to-peer lending platforms as of this year actually dropped to 0. Yes, I mean it's 0. So here, what we see is in just 5 years, peer-to-peer lending has gone from a cutting-edge investor favorite to a disgrace, scandal, and collapse. So my topic today is to explain, what explains this surprising state of affairs, the rise and fall of peer-to-peer lending in China. So to start with the rise of peer-to-peer lending, so we know that China's financial environment comprises of a bank-dominated credit market and an undeveloped capital market. And most credit is extended by the state-owned banks to state-owned firms or the listing sector, leaving large obstacles for private, small and medium-sized firms or individuals to secure financing. And the shadow banks or the financial firms outside the formal banking sector primarily serve the financial needs of the vast private sector. On the other hand, the investment and credit demand of Chinese individuals has surged along with the country's rising middle class. Last but not the least, there's high internet and smartphone penetration among the working class. In other words, the digital is deeply anchored in the economy. So all this contributes to the rise of peer-to-peer lending in China. However, I'm going to talk about the sad stories of short-lived Chinese peer-to-peer platforms. So this chart actually shows all the failed platforms. I may explain two figures. The upper figure is that among all the failed platforms, as you can see, the average mean of duration is 23 months, so less than 2 years. And the median duration is only 19 months. So in other words, a platform survives only like less than 2 years and then die. And on the other hand, on the downward, you can see that the massive platform failure occurred after 2015. So it's from the 300 to like 1,600 and then to 3,000. So this is all cumulative number. Okay, so what explains this massive platform failure? I would say that there are 3 types of peer-to-peer lending platforms in the market. The type 1 is an outright fraud. So I call it the Ponzi scheme-like platforms. So on these platforms, there were actually no loans or faked loans. These kind of platforms, they offer the highest interest rates to attract investors. And basically what they do is Ponzi schemes, using new investors' money to pay back the old investors' interest. And then once such fraud was detected, so the platform owner just grabbed the investors' money and go. So I call it the platform run. So the second type of platforms is what I called shadow banks-like platforms. So on these platforms, the loans are real, okay? And then these platforms are actually quasi banks. So basically they do the bank's business, but they don't have the bank's license. So as a result, they are short of the capital adequacy requirement, other safety nets, and they are they have poor risk management. So poor risk management means actually they don't differentiate well the good and bad borrowers. So when the economy is good, such mistakes can be buried. But when the economy is bad, then bankruptcy happens during economic downturns. So their poor risk management pay the price. So the third type of platforms is what I called the authentic peer-to-peer lending platforms. It's a marketplace-like platforms. So here, the platform is a marketplace and an information intermediary. So in other words, it does not, here it should be does not assume the credit risk. So they are similar to the Prosper and Lending Club in the US. So in these platforms, they conduct loan screening, they conduct pricing, they do matchmaking, and they even help the lenders to invest, okay, using algorithms. So on these kind of platforms, their viability or sustainability depends on how smart their algorithm is. Okay, how are their algorithms able to differentiate and differently price the different types of borrowers, and also the availability of high quality borrowers on the market. Okay, in some circumstances, they are truly competing with the banks on the high quality borrowers. I would like to introduce to you the new trend in the peer-to-peer lending, which has happened in China and in other countries as well. So the new trend of peer-to-peer lending is what I called a re-intermediation in Fintech. So over the time, the online marketplace lending platforms have evolved from a mere marketplace to a credit intermediary and delegated asset managers. So in other words, they not only provide information and marketplace, they also, like a credit intermediary, they select, okay, they screen the borrowers, they give the price, and on the other hand, they are a delegated asset managers. So in other words, the investors is delegating their money to them for their own algorithm to help the investor to invest in those deals. So I have a recent study which investigates this situation. Okay, this helps the investors, Okay, so they can green scheme the market. They have information advantage. They have speed advantage. However, this creates its own problems, especially there's a conflict of interest when the platform owner acts for both the borrowers and the investors. So because basically their source of income comes from not only service fee, but also the asset management fee. So this creates conflict of interest. Okay, then the key question is what causes the fall of peer-to-peer lending in China? So as I mentioned earlier, when the economy is good, most problems are buried. However, during the financial crisis and the economic downturns, they hit all three types of platforms. Okay, so investors withdraw, so the borrowers default, and then, yeah, all these actually leading to massive platform failure. And the massive platform failure in China actually causes millions of investors to lose their life savings. And then these investors, they demonstrate in Beijing, in every city, they accuse the regulators for turning a blind eye on that. And then they generate social unrest and political risk. And then the response from the government is, being unable to differentiate good and bad platforms, the Chinese government start to crack down all peer-to-peer lending platforms by requiring them to either obtain a bank's license or other types of license, or require them to exit from this market. Okay, the government also set up some asset management companies to assist the compensation and orderly exit of these platforms. So because the regulatory burden becomes suddenly higher, the increased regulatory and capital requirements for peer-to-peer lenders threatens the sustainability of this business model and causing most platforms to fail. My last slide is, okay, so given these lessons from the Chinese peer-to-peer platforms, what are the lessons for other countries? So I think that the other countries' peer-to-peer lending platforms also encountered similar problems. As the global economy went into lockdown due to the COVID-19, the default rates, okay, on the surges, which caused more peer-to-peer lending investors they lose their money, and they tend to withdraw from peer-to-peer lending platforms. This leads to more platform failures. Of course, right now we see the good signs of recovery, as the previous speaker suggested. Okay, and if we review back on the China's experience, I think that adverse selection, moral hazard, and under-regulation, they appears to build the foundation of the peer-to-peer market crisis in China. And this leads to regulatory crackdowns. I keep on thinking that because China is from the no regulation to over-regulation, which kills this industry. So I'm keeping asking myself, could this problem be solved by market competition, or the technology could solve this problem partially? Okay, so for example, when the number of platforms is dropped from 6,000 to only 10 or 5 biggest ones, can these 5 biggest ones survive by accepting the regulatory burdens? So eventually, I think the success of peer-to-peer lending relies crucially on the technology-driven efficiency enhancement. To what extent the technology can save the cost, to what extent the technology algorithms can differentiate and properly price the good and bad borrowers. So this is one thing. The other is the affordable regulation. Okay, so suddenly requiring all the peer-to-peer lending platforms to have the level of regulation by the banks is crashing them. I think these lessons applies also to other fintech innovations, payment, blockchain, wealth tech, cryptocurrencies, etc. So that's all I want to share. Thank you.
Thank you very much, Prof. Lu. I think it's very interesting on how you bring up the peer-to-peer lending industry explanation what happened in China, because we know that China is one of the fast-growing, and you also mentioned that, but it's start to collecting and fall due to some another reason. And you can also we can also highlight some few that in order to have a resilient peer-to-peer lending industry, that it could rely on two things that are technology-driven efficiency and affordable regulation. So to all of the participants, if you want to know more about the peer-to-peer lending, particularly in China, you may have a question and drop the question in the chat box with a certain format that already informed to you by the organizing committee. And I think without further ado, we need to proceed to the next speakers. Another speakers for today, the fifth speaker is Professor David Lee, a professor of finance program in School of Business Social Sciences, Singapore University. He got a PhD from the London School Economic and Political Sciences, LSE London, and do his master also in the LSE. And he has a lot of professional activities. One of them is the vice president of the Economic Society of Singapore. Without further ado, so let's meet Professor David Lee. So,
thank you very much,
it's
Professor
good to see you, Prof.
Duarte. Can you hear me?
Yeah, perfectly. So please, Prof, platform is yours.
Yeah, thank you very much for having me here today. And I'm glad that I can catch it in time to present it in person. Okay, Professor Graho, ladies and gentlemen, I would like to first thank the organizer for the invitation to this very prestigious conference. It is a great honor to be able to share some observation about CBDC and beyond. Let me go on to the slides. First, let us look at the classification of central bank digital currency. There are so many definitions that sometimes it can be confusing. Perhaps the most confusing is whether a central bank initiated digital bank currency is indeed a CBDC. This confusion arises because it has to do with the accounting classification of whether the digital currency is a liability entry in the central bank accounting system. The former chair of the People's Bank of China and the National Bank of Cambodia, assistant governor, have both clarified that China's DCP or Digital Payments Project and the Cambodia Akron project are both not CBDCs. Dr. Zhou Xiaochuan highlighted the difference between China's DCP system currently being tested in China and similar initiative under development by G7 countries at the Budapest Eurasia Forum in 2020. So DCP is a two-tier project that includes several payment products collectively named as ECNY or Digital Chinese Yuan. The first tier is the central bank itself, and the distribution of the CBDC is done through the second tier that includes commercial banks, telecom operators, and e-payment platforms. While the first tier is concerned about currency issuance, the second tier institutions have heavy responsibilities. These responsibilities include inadequate risk capital, KYC, AML, privacy protection, and the system's smooth running. Both Dr. Chow and also the Excellency Dr. Suri Chia from Cambodia reiterated that the approved digital currencies are wholly fiat-backed and are not classified as a liability for both their central banks. Chinese yuan backs the digital currency ECNY, and Cambodia Bakun is backed by either the USD or the Riel, which is the local currency. So this digital currency resembles Libra, which is by Facebook, now renamed Diam, that belongs to a class of stable coins fully backed by the US dollars. Perhaps the only difference is that the central bank has not approved Diam, while the USD-backed Bakun is legal tender in Cambodia. Viewed as a stable coin, the USD Bakun is similar to Diam or other USD-backed coins. And the US Office of the Controller of the Currency, in its interpretive letter 1174, states that the bank may use stablecoins to facilitate payment transactions for customers on an independent node verification networks, meaning distributed ledger or blockchain, including by issuing a stablecoin or by exchanging that stablecoin for fiat currency. And that also that a bank must conduct these activities consistent with applicable law and safe and sound banking practices. This opens up the entire new frontier for stable coins, but likely that the devils are in the details because there are so many regulatory agencies in the US. There will be more discussions as the landscape develops with cross-border usage of these stable coins. So as in Hong Kong dollars, the existence of government-authorized notes issued by private entities is not new. There were even instances in history that the Hong Kong dollar was circulating outside Hong Kong. In China Wei Highway, a British colony from 1898 until 1930, the Hong Kong dollar was circulated jointly with the Chinese yuan from the year 1914 to 1930. In Hong Kong, Spanish, Mexican, and British trade dollars minted in other currencies from India were also circulated and used in Hong Kong in the late 1800s and the early 1900s. So it is common for other currencies to be used in other countries, and we are seeing that happening once again. So the popular stable coins resemble the currency issued under the currency board system, except that they are not government-backed, but issued by the corporates or trusts. This form of digital currency is similar to the link exchange rate system, also called LERS, of Hong Kong, adopted in 1983, with 100% backing by the US dollar for the Hong Kong dollar. The LERS is based on the set of rules and governed by currency board principles, with a high degree of credibility and transparency. 3 commercial banks in Hong Kong are authorized to issue the banknotes backed by the US dollar. And history tells us that stability is essential, and a more than full reserve system has a lot of merits. And according to this table that you see in the slide, and if it's classified correctly, CBA is a central bank authorized digital currency that is not a liability in a central bank balance sheet. And the central bank issued digital currency, or CBI, is a liability in the balance sheet. Why then is the need to invent another concept of CBDC when all the current payment system can perform similar function as the Hong Kong dollar? Why is there so much attention and research on CBDC? In particular, CBA or CBI leads to a new payment system that facilitates more inclusion, both in terms of new business organizations and also financial inclusion. So to answer this question, perhaps let me try to present 2 different tracking and accounting methods for the movement of this central bank authorized digital currency. That leads me to the second point of today's talk, distinguishing between unspent transaction output, and you see the UTXO there, and state-based account. Both methods are used to track and trace digital currency. In order to track the payments, UTXO and code-based methods are used. One either tracks the transaction with UTXO or captures the state of the ledgers using codes. There are no accounts or a record for user balance in a UTXO-based ledger. Instead, the central bank digital currency is stored as a list of unspent transaction output, or UTXO. Each UTXO has a quantity and criteria for spending it. Let us give an example. Existing UTXO, denoted as Y, as you see there, has to be spent totally and completely. Once spent, this spent coin Y is removed from the pool. If the sender wishes to send X to someone, he will send X to the intended person and then the balance back to himself. But this original Y will be marked as spent and cannot be spent again. Both X and the balance Y minus X are the new UTXOs, while the OY is no more a UTXO. Transactions are created by consuming existing UTXO and producing new UTXO in their place. A UTXO is akin to a list of central bank digital currency that gets transferred by satisfying the current spending criteria and can be divided or combined to create the denomination needed for a particular transaction. According to People's Bank of China, it uses this UTXO method to keep track of every transaction in ECNY. Okay. So let me go on to the next slide. A state-based ledger, on the other hand, can capture the balance of the CBDC user account at any state. Instead of having each digital currency be uniquely referenced, they are represented as a balance within an account. Accounts can either be controlled by a private key or a smart contract. The distributed ledger may contain information at a particular state at a particular time. This information may include the balance of anything of value, such as CBDC, the associated code, and any other data. Okay. For example, Hyperledger IROHA can create and manage simple digital asset like CBDC or complex one like your identity, indivisible rights for property, certificate authenticity for health certificate, and patents. Project Bakun uses the state-based account balance approach with IROHA, and Project Wubin by Singapore experimented with various distributed ledger with digital Sing dollar on Ethereum private blockchain. And MES Ethereum was designed to be compatible with current account system and real-time gross settlement system known as RTGS. It allows for a working integrated transfer protocol to facilitate payment versus payment and delivery versus payment, meaning to facilitate forex trading and settlement for asset purchases. So Cambodia's Bakun project is a blockchain-based CBA using Hyperledger IROHA blockchain. While IROHA can create digital assets, it is unclear if such facilities are available. Nevertheless, it's an option. CBDC is issued and monitored by the country central bank, and it is not without centralized control or decentralized like Bitcoin. An efficient e-payment tool can fulfill the objective for financial inclusion. For example, the cryptography key is used for easy transfer offline among unknown parties, and this UTXO that we talk about, or state-based distributed system, may be used to capture the entire transaction record. CBDC residing on such distributed payment system may use a set of cryptographic keys that allow for easy transfer between parties without a formal bank account. This category of CBDC without a centralized clearing system is particularly useful for retail CBDC as it improves society welfare level, especially in emerging agriculture and rural economies when the centralized third-party payment system is not efficient or not even available. A centralized clearing system with 2 or 3 parties is different from a blockchain-based ledger. The cost of adding new businesses to the nodes and therefore being part of the payment community is much lower, especially if there are no pool or reserves required for settlement. It is all about tracking the CBA that's fully backed and exists on the blockchain. The conduit is not a single conduit for payments, but a community with each acting as a node. The main welfare improvement comes from the inclusion of more users, more payment agents, goods and services into the financial system. More importantly, as Project Rubin demonstrated, smart contract facilitate application beyond just an efficient payment system. But not all CBDC are blockchain-based, depending on the purpose and design. So let's look at the, finally, let us discuss the potential of the new payment system and digital currency. It is important to differentiate between what technology can do and what the policymakers wish to harness for specific purposes. When one wishes to ban Bitcoin trading or ownership due to energy consumption or because of money laundering, it is difficult to ignore the technology of Bitcoin. UTXO is one and blockchain is another. Blockchain on its own is not a solution for financial inclusion. However, combining blockchain with smart contract will lower third-party trust and eliminate counterparty risk. As a consequence, the cost of payment system can be drastically lower. How does blockchain reduce the counterparty risk of even untrusted party? Payee and payer need not know each other's identity in a public blockchain, just the public address or account. Combining the 100% fiat backing and the fact that the private key can move the CBA from one account to another almost instantly on a blockchain, this design has almost no settlement risk or in need of risk capital designated for settlement. The CBA is like cash in a wallet, and since the settlement and counterparty risks are almost zero, the third-party cost is significantly reduced, making it a viable means of serving the underserved. This is the advantage of blockchain, regardless of whether the payee and payer know or trust each other. The choice of CBA design is very much dependent on the design of the payment system, and vice versa. They are not independent. The business model has to be socially scalable, secure, and affordable. Even though many of the current e-payment systems can serve the underserved, they have not been very successful except in China. One of the cited reasons is tight regulation, besides the need for risk capital provision to lower corporate risk. This can be solved by blockchain with almost real-time transfer and without corporate risk. While the e-payment accounts are exposed to corporate risk, CBA fiat reserves are marked and backed by cash in the central banks. We have also seen Cambodia slowly leveling the playing field between banks and e-payment companies because of the new payment system. We have made many assumptions in our discussions without full knowledge, knowing that there are many different permutations and combinations for CBDC and the payment system. The purpose of the discussion today is not to prescribe the best design or that the new technology is better than the old, or pretend to know the exact specification of individual CBA. I'm not in the position to do so. Instead, the discussion here is to imagine the potential of CBDC. We stretch the imagination to see what we can do with the new technology. It may sound like we are promoting technology, but this is a futile exercise. It is better to view technology design awareness as an invitation to change corporate and human behavior. We may not want to underestimate blockchain's potential to bring untrusted and competing parties to the table. Neither do we wish to underestimate the potential of using blockchain to serve the underserved. We have already seen that not many new blockchain projects can be without third-party trust, especially if Internet of Things or hardware are involved. It is just that a new form of trusted third party is needed and the lower cost and lead to lower cost. That lower cost is a catalyst, and that redefinition of relationship is empowerment for inclusion. Many of these suggestions will require a lengthy process of changing law and regulation and affecting the current market structure. If the system is efficient, there's little reason to adopt CBDC and a new system. However, this is unlikely to be the case as we have seen the power of smart contracts, blockchain, and other technology. Taking advantage of this for CBI, several Asian central banks are focusing on cross-border remittances. These include the Project Ubin of Singapore and Intanon Lion Rock project, the latter MCBDC Bridge of Hong Kong Monetary Authority, Bank of Thailand, People's Bank of China Digital Currency Institute, and the Central Bank of UAE is promising for remittances. Project Ubin is at the stage of commercialization, and as for CBA, Cambodia, who has a lot of foreign workers, is working with Maybank in Malaysia for the migrant workers in Malaysia to remit back to Cambodia, Cambodia. But there are more potential than we can see in front of us. In China, hardware wallet with fingerprint access makes full use of the public key infrastructure. It functions like spending cash from a physical wallet. Only the owner can use the private key stored in the device activated by biometric identification. The hardware wallet service serves the underserved and digitally unsophisticated. With a password, it provides another layer of protection. Of course, it can be lost or stolen. If the owner is anonymous, it is similar to cash or prepaid cards. Some would wonder whether there is any advantage in using CBDC since traditional methods can do the same. They argue that there is no advantage at all if the owner's identity is revealed. Technically, regulation can allow for a small amount to be anonymously transacted. Based on materiality, a larger amount can have more stringent KYC. This may not be an interesting point to discuss now. Nevertheless, when privacy becomes valuable, allowing anonymity may be an option. That's not to confuse anonymity with privacy protection, but anonymity is a form of protection. Through CBDC and DeFi, or decentralized finance, pair trading of various assets and durables and livestock is possible. Fractionalization ensures greater liquidity as well as affordability of assets. Decentralized finance, or DeFi, is a form of finance conducted on decentralized platform and with smart contract. CBDC allows for the possibility of barter trade with smart contracts. By pairing CBDC with products and services, these pair trades increase the liquidity and reflect market value. DeFi leads to a more transparent and equitable market that minimizes price distortion, especially for the agriculture and opaque markets. It prevents hoarding and profiteering, as any attempt to corner the supply will increase the price autonomously, leading to little profits for rent-seeking behavior. So, in summary, we presented the three concepts. The first is that CBA is fully backed by fiat and behaves more like cash than bank deposits. Second, the distinction between UTXO and account-based methods will enhance the imagination as you have a second ledger besides the ledger for CBA, as this additional ledger can keep track of the coding that will allow smart contract to do a lot more than we can imagine now. Finally, the use of DeFi and non-fungible token allows CBDC to realize its potential value via blockchain interoperability and facilitate on-chain and cross-chain forex transaction and asset purchase. These three technologies, if deployed well, have given government many options previously not available to them. We have seen how the Asian financial crisis, global financial crisis, and now COVID disrupted the payment system, and therefore the economy's normal function. We have seen trade shrunk 30% because the non-acceptance of letter of credits by banks acting as counterparty. CBDC can bypass intermediary, and the fact that central banks are not advocating bypassing does not lessen the option value. This option value can entice corporates' inclusion, thus lowering the cost of third-party trust and introducing new form of low-cost third-party and improving collaboration efficiency. It is a technology that increases overall economic efficiency via collaboration efficiency. We cannot underestimate what CBDC can do to business inclusion. Hopefully, with the understanding and appreciation of these three concepts, the design of CBDC is towards serving the people, empowering the excluded, and leveling the playing field. So thank you very much for inviting me, and I'll now pass back to the chair. Thank you.
Thank you very much, Prof. Lau. Such a comprehensive explanation on how we could understand about the central bank digital currency. You start talking about the classification and then the potential that could do by the CBDC and how this financial transformation could build another innovation, so we could do what we call that the financial inclusion easily. So I would like also to remind all of the participants, if you have a question regarding the very specific material on the CBDC classification and another issue on the CDBC, you can address to Prof. Lee, bring up the question to the chat box, and we will have the discussion on the question and answer session. And without further ado, I think the next speakers already be with us. Dr. Wong Yong, Associate Professor, Department of Economics, Faculty of Business and Finance, Universiti Tungku Abdul Rahman, Malaysia. He got a PhD from the University Putra, Malaysia, and has a lot of professional experiences. Some of them are the Research Fellow, GLT Capital Advisor, Malaysia, and also Senior Associate on Bond Research Center, Malaysia brand. So good evening, I guess.
Good evening, Devanti.
Okay, Dr. Yong, you have 20 minutes, so platform is yours.
Thank you, Devanti. So perhaps I guess you can see my PowerPoint clearly.
Yes, right. But would you please do, okay, perfect.
Is that okay? All right.
Yeah.
Okay, so thank you, and good evening and good morning to all of you, depending on where you are. Thank you once again for the organizer for the invitation. So it's really my honor to be part of the prominent scholars in this prestigious conference. So in the next 20 minutes, I would like to share my thoughts on this fintech, especially on the impact of this fintech on the monetary policy, the conduct of monetary policy, as well as the effectiveness of the monetary policy. But it's not so much on the fintech itself, but more on the policy implication of them. So the thoughts are mainly based on the papers that I have co-authored with my co-authors. All right, so as well as a paper they're under review at this moment. All right, so financial innovation is not something new, right? Because we have been there before, and we do know that financial innovation will change the way that monetary policy is conducted. So, like for example, when we started to have this financial innovation in the mid-1980s onwards, it changed the way that monetary policy was conducted from the so-called money supply targeting to interest rate targeting, right? Because right before that, monetary policy was all about money supply. But once we have the increasingly use of all those electronic cards, ATM cards, credit cards, for example, then it starts to mix the demand for money getting unstable, and therefore it shifted the way that monetary policy was conducted then. But even so, financial innovation never undermined the effectiveness of monetary policy, because the way that when we have more and more bank-oriented financial intermediation, so what happened is that the linkage between the private non-financial sector together with the financial institutions, the banking institutions, they are linked through claims against and as well as issued by the financial institutions. So if you are, for example, having claims against the financial institutions, who are becoming the depositors and therefore supplying the liquidity to the system to be used by the borrowers, those who hold claims issued by the banks for so-called productive use. So this is how, therefore, the liquidity is put into the productive use. And exactly because the banks, they have claims on the central bank's reserves. So this is how central bank will have the so-called the policy realm, including, what I call the encompassing the banking institutions. And it is exactly because of that, and therefore central banks, they are able to insert leverage on the economy through the banking system, right? So for those who we learn monetary econs, we are very familiar with the so-called bank lending and the balance sheet channels of money transmission. This is exactly because of the, the assistance or the deepening of this financial intermediation, in fact, provide additional monetary transmissions to the conduct of monetary policy. So, this is exactly a short, what I call a simple snapshot on the fact that exactly because banking intermediation falls within the monetary realm, and therefore central banks is able to have their influence on the economy through the banking system. Until it does in the sense that when we talk about fintech or financial digitalization, this kind of innovation starts to change the landscape for the conduct of monetary policy. Like, for example, we talk a lot about virtual currencies or the so-called decentralized digital currencies enabled by the distributed ledger technology, the so-called blockchain. So it brings what we call the currency competition with the fiat money. So and we certainly still remember the shockwave sent by Facebook by the time when they start, they introduce the potential introductions of Libra. All right, so that imagine that in the community with 3 billion users, what I call twice the population of China. So that could completely change the way that monetary policy is conducted in the world. Not only in terms of the digital currencies, but in terms of, for example, the payment systems. We have getting more and more commonly used e-wallet, for example, offered by all those e-money operators. So the problem is that all those e-money operators, they are staying outside the monetary realm in the sense that they do not talk to each other. For example, we are still talking about interoperability between all these e-money operators. They have no access to central bank reserve, for example. Therefore, in a sense, they are very fragile to conventional bank run. So if you look at this, a simple description where this platform finance, I use the term platform finance in a very general sense, which could include P2P financing. It could include, for example, those platform finance, those what they call fintech credits offered by the big techs to those the businesses operating on their platform. So because those platform finance, they are outside the territory of the policy, the regulatory territory of central banks. So therefore, you can imagine the consequences is whatever policy that central bank has on the interest rates, it may not reach the platform finance, and therefore it may not reach the borrowers and the investors, or I just put it, using the term depositors, so that it could be comparable to the depositors in the traditional banking intermediation. So therefore, the policy will not reach to the economy, intended by the policy itself. If we move from virtual currencies, from payment system to digital finance, to fintech finance, then I would say that it will even more complicate the effectiveness of monetary control. All right, for two simple reasons. Because when we talk about the conventional banking intermediation, what happens is that you have a centralized lender, even though depositors are the one who supply the liquidity, but it is always the banks who carry out the intermediation, what's called the maturity transformation, as well as you always require collateral for financing. But if you think of this digital finance, which number one, all these individual lenders, the so-called investors on the platform finance, they are the one who, through the platform, they are the one who directly deal with or invest on those borrowers' projects. So in that sense, unlike the centralized banks, they do not have any claims against the central bank. So in that case, central bank will have that territory on all those individual decentralized lenders. So in that case, whatever interest rates that the individuals are offering willing to offer where through the platform, they are not affected or influenced or shaped by monetary policy rates. So in that case, the so-called bank lending channel that we used to learn about will become obsolete. As well as when you do not require collateral, for example, in the platform finance, then the common idea of what we learned about the so-called agency cost of lending, therefore, again, will be decoupled from monetary policy. The net of borrowers are no longer irrelevant in loan formation, but more about the data, data about the performance of the borrowers in the past instead of the collateral that can be offered by the borrowers. So the balance sheet channel that, again, we are familiar with could become trivial as well. All right, so therefore, in a paper that we have published in the past, the last year, so we tried to look at how the emergence of this platform finance could reshape the transmission of the monetary policy. So we do so by incorporating a two-sided platform literature into the DSG macroeconomic model. So therefore, we offer what we call platform density channel. So unlike the bank lending channel, unlike the balance sheet channel of monetary policy, which enhance, in fact, the conduct or the effectiveness of monetary policy, this platform density channel, it actually defies the monetary policy position. Like, for example, a very simple, what do you call it? A chain of events here. Suppose you have a drop in the monetary policy rates, right? So a drop in, therefore, a bank's deposit rate. So if you think about that bank lending channel, that of course at the end will be transmitted into a lower bank lending rate as well, therefore with a cheaper external borrowing cost through banking system. So that in a way, of course, will the stimulate the demand for loans. But that therefore let me see if there is any chat related to, all right. So we have still 10 minutes. So, but in other words, being an alternative source of finance for firms, the demand for the platform loans will be falling. So, the platform needs density. So in order to maintain the density of depositors, investors, so they have to raise the return or payoff to the investments on the platform. And in order to maintain the density of borrowers at the platform, therefore, they have to reduce the success rate or the interest rate charged on the loans formed through this platform, right? But of course, with other factors as well, at the end, both paid off to the investors as well as the platform loans rate will be rising. So this is completely in opposite to the monetary policy stance, which trying to reduce the what I call the loans rates, the deposit rate as well. All right. So this is the what I call impulse response functions for a case when you have a positive shock on the monetary policy. A positive shock here means monetary policy rate is increased by 1%, and with that kind of platform density channel, then you actually oversee what I call, you can observe a drop in the P2P or the platform loans rates as well as the platform deposit rates. All right, so with that drop in the deposit rates as well as the loans rate, the platform, so they actually stimulate the transactions, the formation of this, the financing transactions over the platform, and you have increasing density of both borrowers and depositors. Therefore, so you could see, therefore, the intention of the restrictionary policy itself is to reduce the lending and borrowing, but the platform itself goes the other way around, where you in fact observe even more financing activities over the platform. And it is not just the conjecture of the model, but we started to have empirical evidence For example, one of the empirical evidence that I've cited in my papers was conducted by staff from Federal Reserve, aboard the Federal Reserve. They defined the opposite directions between those rates in the platform with the policy rates. All right. So therefore, what's the solution therefore to all those problems? So we have heard presentations earlier, like for example, we allow what I call all these e-money operators to have access to central bank reserves, so that on the one hand it could overcome the potential problems, the fragility of the platform itself, toward the bank run. But on the other hand, by having those platforms access to the central bank reserves, it actually put therefore the platform finance under the regulatory realm of the central bank. So in that case, so perhaps the central bank will regain policy authority over the platform finance, and of course, by introducing central bank digital currencies that put those borrowers and depositors to even open an account or have a reserves account with the central bank. So that itself is a way as well to in fact, using the fintech to enhance, to reinforce the effectiveness of the monetary policy. So, but in this case, I would like to, this is my last slide. So I would like to talk about something else where you can, in fact, even with the presence of platform finance or digital finance, for example, the central bank can in fact bring in even more borrowers, which before that underserved by the conventional banking intermediation. But with this small innovation, in fact, it can bring in those previously underserved borrowers now into the traditional banking intermediation. So the idea comes from a policy run by special, what I call offered by Bank Negara Malaysia during the pandemic period to offer working capital financing facilities through banks to those what I call micro, small and medium enterprises. And those loans, they are actually guaranteed by the fiscal authority. So they are what we call publicly guaranteed loans. And therefore to offer those loans as a working capital loans to the SMEs affected by the pandemic. Now, inspired by what the literature about how to in fact collateralize or pledge these publicly guaranteed loans, or put it this way. So I therefore in this paper I propose a way on how to automatically refinance these publicly guaranteed loans by allowing the banks to refinance or to repledge those loans that has been dispersed under the scheme, because those loans, they are already being guaranteed by the fiscal authority. So in a way, they are safe assets. So they can be used as collateral and being pledged to the central bank for another round of financing and through the banks, and therefore those financing could be dispersed to the small and medium enterprises as working capital loans. And because those second round of loans, they are also guaranteed by the fiscal authority, and therefore those loans can be again repledged, to the central banks for third round of financing. So that kind of automatic mechanism to what I call to bring in those micro and small and medium enterprises into the what I call the traditional banking system, even though those borrowers may not have sufficient collateral, which therefore are underserved by the traditional banking systems before that. But because those loans are guaranteed by the fiscal authority, so in that case, it doesn't require collateral in order to obtain, to get those working capital loans. So that has a very important, so last point, that has a very important consequence. By providing loans, working capital loans to borrowers through central bank lending, central banks are able to decouple the bank lending rate from the bank deposit rates. So because this is not the case that we used to learn in the past, where the bank deposit rates and the bank lending rates, they are coupled. And therefore, whenever you central bank increase or reduce what they call the policy rates, both lending and deposit rates, they have to be, going up and going down together. But by having this small innovation in the way that loans can be dispersed to the borrowers, once the lending rate and the deposit rate can be decoupled, that in fact gives two different policy instruments to central bank. One is to deal with the depositors, but one is to deal with the borrowers. All right, so with that then, so those are some simple thoughts that I have on how to, what I call the implication of the fintech of monetary policy, as well as on how to overcome those limitations. So with that, then I end my presentation, and thank you very much.
Thank you very much, Dr. Wong Chi-Yong. Apparently, it's not like a simple thought. I'm pretty sure it takes a lot of energy to create that and presenting those kind of new insight for us. Also, how the like the financial technology in this term related to the digital transformation and you connecting into the monetary policy. It seems like what you discussing just now, it's completing what we have discussing with the other speakers. So cannot wait to have a discussion with you in the question and answer session. And proceed to last but not least speaker for today, Dr. Putra Pamungkas, researcher at the UNS Fintech Center, Universitas 11 Maret, also the lecturer at the Faculty of Economic and Business, Universitas 11 Maret. He got the PhD in economics from Universiti de Limoges, and without further ado, bring up to you, Dr. Putra Pamungkas. It's really good to see you, Dr. Putra.
Thank you very much. So I would like to take the opportunity to say thanks to all speakers here in this webinar. For your knowledge and sharing about the development of the fintechs and the digital transformation. I hope people on behalf of UNS Fintech Center, I would like to say thank you very much. And I hope the student and people here can learn about this recent development in digital transformation, and also we have a wider knowledge about what's going on in the world and what's going on from the regulators. So today, this evening, I would like to share about our last what we are doing in research in our fintech, in our research center. I hope you can see it, Dewanti.
Perfect, Dr. Putra. Would you please to put it in the slideshow mode, please?
Yes.
Okay, perfect.
Okay. So I think that the keynote speaker, Pak Doni Joewono from Bank Indonesia, and then also Pak Didik from IDIC, and Pak Imansyah from OJK has covered a lot of things in regards with the development of digital transformation in Indonesia. So I would like here to share what we are doing in our research centers, and this is the current works with the chairman of UNS Fintech Center, Pak Irwan. It's because of the important things about this disruption is the first thing is to adopt, then the society can adapt. So we are talking here about this digital adoption of SMEs during the pandemics. So it generally considered that in that substantial proportion of household in Indonesia depends on their small micro enterprises for their incomes. So over the years in Indonesia, a set of, as the keynote speaker said, a set of innovation in the financial and non-financial aspect were generated to reach out the micro and small medium enterprises as the technology getting cheaper and more accessible to everyone. So although we think that some affirmative policy have to some extent been implemented into by the government, by the regulators to boost the performance of those enterprise, we see that we have still some obstacles. What happened here in Indonesia, the obstacle remain in place. So however, the mobile revolution, we could say mobile revolution, particularly the penetration of the mobile phone and internet, it's open up the set of possibility for innovation to improve the business process of the micro, small, medium enterprise by enabling the technology. So also we see some literature, some previous literature have pointed out the importance of technology and adoption, and also the capability for SMEs, for micro, small, medium enterprise, to improve their performance and also efficiency and also the competitiveness. And these several factors from the digitalization process that could impact the SME business model, it's motivate us to investigate the determinant, the determinant of the adoption of digital technology on SMEs. And also we find that the effect is more pronounced during the pandemic times. So the COVID-19 pandemics has shifted the behavior of people because of restriction in the movement, lockdown policy, and etc. So the principal objective of what we are doing here, I would like to share about this current research. What we are doing here is the principal objective of this work is to clearly understand the barriers, the obstacles to micro, small business in the use of in the adoption of use of the digital technologies in Indonesia. We also investigate the condition of course, during the economic uncertainty, the condition during the pandemic 19, which arguably the adoption of the digital technology is significantly increases. So here we have also during this pandemic, also the way we research, the way people is changed. So we do some survey data, but we do the online data. We do the online survey to get the data of the more than 2,000 micro enterprise and small businesses located in Java Island. So what we are doing here, the measurement we do that we ask the small business enterprise to what kind of a digital device, what kind of digital business process, what they are doing like that. So our digital adoption things here we measure as they use the small business using the online marketing, use the online payment like a QR code, it's very common also in Indonesia to use a quick response code like in China, and also they use the online point sales to record, basically to record the activity, to record the cash flow of the micro, small, medium enterprise here in Indonesia. So we also try to investigate, try to see what the effect of the business factors, like the business factors, and also the firms factors, and also banking factors, and also the last one is the COVID-19 pandemic. So we investigate more than 2,000 micro. We have the data more than 2,220. It's very beautiful numbers, 2,222. So to see the determinant of the adoption of the digital technology, as we see here, we use this as online marketing, payment, and point of sales. And so here I would like to explain a little bit more about our digital adoption here. So and also the several factors that can affect the adoption, that can be the determinant of the digital adoption. So we have four major factors. Basically, it's a business. It means like business factor. We have to take into account the model, the business model. For example, the business that reduce the physical visit to the store, and so also the age of the firms, the age of the owner, and also do they have the banking's exposure like a lending or etc. And also what happened during the COVID-19 pandemics. So we find that our result, our logical profit analysis, we find that business factor, firm factors, and also COVID-19 pandemic factors is most likely to have increasing the probability for SME to adopt the digital technology, digital adoption. So in this business factor, we find that the pressures from the competitors in the same business, which using the technology more likely increase the probability to use the digital device, or to increase the adoption of the digital technology. So also the reducing store visit due to this condition, due to this restriction in movement, and also increase the probability of the SME to adopt the digital technologies in their business activity. Also, the customer factors that asking because of now the trend is in millennial people, in millennial groups of people, and also it's they are using the QR code, they are using the electronic payment, they are using the phone to pay in businesses. So that factor, that people or customer asking whether the affability of the payment system, electronic payment system, is also associated with this increasing digital adoptions. So the firm factors, we also have that we find it's really interesting that we have the older people are less likely to use the digital technology. Of course, it's the younger you are, the more native you are using this the device or digital marketing or digital payment. And also the firms, the older the SMEs, they are also less likely to, the probability is decreased using the digital technology. So also we find that the education, higher education, if the owner have higher education, they most likely use the digital, they adopt the digital technology. So of course also the internet, the network, and everywhere. The network of the internet is also boost the probability of the SMEs to use the digital technology. So during the pandemic, we observed that the firms that using the digital or has adopted this digital technology, like online marketing, online delivery, online payment, they most likely have the higher income and higher total selling. So we go deeper into this COVID-19. So we find that that this is very interesting, findings that we find here. But we have a lot of so the determinant of this digital adoption we can see from the business factor, firms factor, and also what happened during the pandemics. So in this work, I think I should stop here to conclude that we estimate these empirical models of the determinant of this technological base using the data more than 2,000 micro small enterprise in Indonesia. So we find that this business factor, form factor, and pandemics has affected the probability of people, the probability of the firms to adopt this digital technology. So therefore, it is also essential to identify these practical steps that we can take to address these barriers. So for instance, we improve the digital literacy that can be addressed to less educated people and also relatively elder people, that we can see this literacy of the digital that can be addressed of this by looking at this result. So also internet coverage is also very important in order to adopt this digital technology. Of course, internet is the soul of this digital adoptions, I guess. So to be effective in this business digital activity day by day, something like that. So that was my brief presentation for today. I hope it's not take too much time. Thank you for all, and go back to Diwanti. Thank you.
Thank you, Dr. Pamungkas, for delivering us the empirical works that has been done by the UNS Fintech Center on how the UNS Fintech Center tried to determining the adoption of digital technology by the micro and small medium enterprises, and you found that the business firm and the pandemic factor is in such a way implement what do we call as affecting the adoption level of the micro, small, and medium enterprises firms. So thank you very much. And I think I would like to invite all of the invited speakers to open up the camera, because we will have the question and answer session. So you can have interaction with the audience also. I would like also to remind the audience that shortly the committee will drop the attendance list link. So we invite you to fill in the attendance list. That will be our base to send the certificate along with the material and the recording of this session. So without further ado, I think let's start the question and answer session. So the first question will be answered by Dr. Wong. We have a question. We have some questions, so I need to pick up the most relevant one to the material for today. So the question coming from Amalia Saraswati, and it goes to Dr. Wong. You were suggesting that digital financial institutions should have an access to central bank funding because it will expand central bank's control over such institution. However, it's not providing access to this institution means that they will be required to follow tight regulation for conventional bank. Do you think this will harm their sustainability? So please, Dr. Wong.
So this is, of course, a balance that you that you must achieve whenever you talk about the flexibility in the financing itself, as well as the requirement or the need of regulation. All right. So, but without having access to I mean, you can imagine a lot of benefits of having access to this central bank reserve. Like, for example, we know the very original purpose of having access to the central bank reserve, of course, is to avoid bank run, and you can imagine that whenever you have more and more of your residents putting money in the e-money operators, in which the whole the security of the money completely depends on how prudent the risk management the operators are, and once you have that problems in that e-money operator, so very quickly, very easily, you're going to have a systemic risk hitting the system. So upon that reason alone, then already you can imagine the necessity to bring the e-money operators into that central bank reserves circle. So that it's one of the reasons why I believe it should be. Of course, by having that access, it doesn't mean that it will it will slow down, it will take a toll on the innovation, on the landscape, the fintech landscape itself, because having access to that reserve, it doesn't change or there is no intervention on the innovation itself. All right. In fact, if you want to talk about the competition from the the innovative competitions from the regulations, it will be even more about central bank digital currencies. So that the design, the invention of central bank digital currency will have even larger impact on the fintech landscape instead of that access. So that's number one. And number two, of course, back to the story I'm trying to tell, the ability of central banks to have impact on the banking system and therefore on the economy directly or indirectly through banks is exactly because of that central bank reserves, right? And exactly because of the lack of that access, it is where central banks, the hands of the central banks cannot reach to the e-money operators. It's still fine if you are at the initial stage of the development of fintech payment systems. But when you have more and more fintech intermediation, all right, when it matures, when you have a lot of your residents participating in the fintech intermediation, so it is just a matter of time to central banks will have to do something about that.
Thank you very much, Dr. Wong, for the answer, and I really hope that it will be satisfied over the question for today. The second question is from Puput from the Universitas Erlangga, and this question goes to Prof. Lu. Prof. Lu, we have the question here regarding the peer-to-peer lending in China. So how the government or the authorities in China protect peer-to-peer lending lenders from the opportunistic behavior from the borrower? Is there a specific regulation to monitor and control the financial risk in the peer-to-peer lending industry in China? Thank you very much. Prof. Lu, please.
Okay, thanks for your question. Firstly, I must say that although that the peer-to-peer lending market crisis is very unfortunate in China, but it is unlikely to generate systemic risk because this market size is still small compared with the sheer size of the overall banking and other capital markets. Okay, and of course, you're asking about how the government protect those loss-making investors. Yes, but the starting point is, of course, there's no point that the government is using taxpayers' money to compensate the losing investors. Okay. However, the governments, because in China, the citizens' mentality is that they blame the government. They suffered a loss. So, and then the government did participate in a lot of ways to help protect investors. For example, in the Ponzi scheme, like a platform runs, actually the government is actively engaged in for example, the police and the court, and then to have the criminal liability for those owners. So this serves as a deterrent. Okay, and for the shadow bank-like kind of bankruptcies, so the government is assisting in facilitating the negotiation between the platform and the investors. So very often it is, instead of liquidating, it is a compromise where the investors accept some loss in return for a longer term of repayment. And thirdly, I think the many platforms actually is already shifted their risk to insurance companies. Of course, the insurance companies charging them high. So through various ways, actually, the government is assisting. Finally, the government is setting up the AMC, asset management companies, to buy the bad debt at a high discount from those platforms. Therefore, they have the creditors' rights, and then they undertake to collect, so that the citizens' grievance has been shifted from the platform to the government. Yeah, thank you.
Thank you very much.
Thank you. Yeah.
Prof. Lu, I think Mr. Imansyah, you have some idea that you want to share with Prof. Lu in this peer-to-peer lending in China.
Okay.
Perspective.
Yeah,
thank you, moderator. Thank you as well, Prof. Lu. Two ideas concerning the P2P lending, in particular how we develop the environment for P2P lending business here in Indonesia. One is in the earlier stages when we try to regulate the P2P lending. So actually, we want to have the balance between prudential and also the principle-based regulation, something that is up to the market. But at the other hand, we want to have also an essence of prudential regulation within our regulation in P2P lending. That because of the lesson learned from from China in particular. So, but today there's like something that a shift from principle-based regulation into more on prudential regulation because of the potential on the systemic risk, financial system stability, as well as customer protection. So I think, but some thought also quite concerned with our approach on more on prudential because if you put more prudential regulations into P2P lending industry, it will affecting the growth of P2P lending.
Yes.
Because people who engage with the P2P lending mention we better from the incumbent, but please not push us to comply with more regulation on prudential principles. So how you see on that particular, and do you see any like a good balance for regulators to come up with specific regulations on P2P lending? Because we have like a more than 100 P2P lending here in Indonesia, and at this moment we try to consolidate this P2P lending based on the capacity of the capital, risk management, and also all those things that related to better business models of the P2P lending. That's one issue. The other issue is there's a trend for the e-commerce platform to acquire incumbent bank, Prof. Lu. So how you see about that particular, because you know, this e-commerce platform is far from being regulated or being supervised by regulators. And then afterwards, they are taking now the bank, incumbent bank, an existing bank. So how you see that, and how we are protecting the system from being exposed to systemic risk again and financial stability. That's two issues. And the last one, sorry, I can see from the default on this the role of credit scoring within, because you know the credit scoring may assist the P2P lending in a way how they are calibrating the credit worthiness of the debtor. So I think in our case, we try now to push again something that we can promote the credit scoring initiative into how they can take more role assisting the P2P lending in assessing the credit worthiness of the potential debtor. So I think it's like an ecosystem that P2P lending may not able to develop their own credit scoring. So somebody else will do that area and providing like credit scoring for using by the P2P lending, and then how they are assessing the credit worthiness of the debtor. So I think that's very much how we are thinking about how we are now try to prevent our financial sector from being exposed to credit risk or even liquidity risk and also systemic risk because of this P2P lending industry. Thank you, Prof. That's from me. Thank you.
So, moderator, shall I quickly respond?
Sure,
so,
please.
Thanks for the three very excellent questions. So the first questions on the actually how to balance the innovation and the risk, or what you call the prudential regulation. So indeed, the very reason that the peer-to-peer lending can thrive in China and elsewhere is because on the one hand, they have a technology advancement where they can save costs. Okay. On the second hand, they are facing the light regulation, so they save the regulatory compliance cost. So this is definitely if you impose the bank-like compliance cost to them, definitely they threaten And then, yeah, so they have to charge very high interest rate to compensate these costs. Okay, but that creates systemic risk. Okay? And then the second question on the e-commerce platforms, they are expanding into the financial sector. So definitely, so this happens in China. The Alibaba, the Tencent, so they are tech giants. So they expand, and then they have big data advantage. Okay, their credit scoring, everything is more accurate than the central bank, I would say. Okay, so and of course, if the regular, my principle is if you are doing the financial sector stuff, then you need to have financial kind of the license to do that. So the licensing requirement is imposing the minimum kind of adequacy and internal controls and other stuff to ensure there's a safety net. So I think this is something that. So the third one on the credit scoring, yes. So the I think that the central banks has a kind of FICO system. Okay? So like the U.S. So I think this data, this thing must be shared among these platforms. Actually, this is like a public good, and then help them to improve their accuracy. And on the other hand, the central bank also need to work with the e-commerce companies. Together, we make the credit scoring more accurate, more timely updated. I think that's the way to think.
Thank you, Prof. Lu.
Thank you, Prof. Lu and Mr. Imansyah. So, Pak Imansyah, we have a question from you, apparently. So the question is coming from Destia from Surabaya. So the question is, I'm interested in the discussion of Ponzi. So a few months ago, he was deceived by fraudulent investment, literally using a Ponzi scheme. And it turned out that a victim are very many from several regions throughout Indonesia. So the question is, can he report to the OJK, or there is something that he can do to solve this kind of problem? So please, Mr. Imansyah.
Yes. We're doing like education for improving financial literacy of our society, right? Everybody must know what are the product and services provided by our financial sector industries. Sometimes people not really wants to dig more or have more information coming from the player, from the institution. So I think they're only thinking about to have a quick a quick income, or quick profit offered by this particular financial sector player. So, but they can, what happened. We're always thinking about that people that having an extra offer of income or profit coming from the financial, quote unquote, financial industry or financial institution, must do kind of double checking to OJK, to the authority, whether it's really a licensed financial institutions by OJK, or it's not, or is we call this finance institution doesn't have any license coming from the regulator. So that's one. The second one, if they still being taking the offer from these financial institutions, then if there's something that happened to them, they can report to OJK. We have this, what we call this task force for investigations for this for the investment, Satgas Waspada Investasi, what we call this SWI. It's not only OJK, it consists of other authorities. So at the end, we can just push this this company, this corporate exit from the financial sector, and put these people into our what we call this daftar orang tercela. So something that that's the only one, because it's we don't know what from the beginning. So I think again the point is how we can increase the financial literacy of our society. Otherwise, it still happen. It always happen. People always being used by these irrespectable company using people with their less understanding of the financial product and services, just offer, and that is mostly in a form of Ponzi scheme. So people that having the first join, then they benefit a lot from the Ponzi scheme, but the later one just suffering losses. That's really what is the Ponzi scheme. I think what's Prof. Lu mentions type of P2P lending is also happened to Indonesia, and a lot of cases here in Indonesia probably because of this Ponzi scheme.
Yeah. Yeah. So
but
thank you for
logic, and we can have some further actions to this particular company offering the Ponzi or practicing the Ponzi scheme. Thank you.
So thank you, Mr. Imansyah. And I think we need to proceed to the next question. It's for Prof. David Lee. It's from Lyudmila. In your explanation, you mentioned that CBDC system is different from the blockchain system. To this day, some people still have distrust over the safety of blockchain. In this regard, how CBDC will differ from the blockchain in terms of the safety, and what kind of regulation the governments need to prepare to ensure the safety of CBDC used in the community? So, Prof. Lee, platform is yours, please.
Okay, I mentioned that in Cambodia, they are using blockchain for their CBDC, but also in China, they are not using blockchain, but they do use blockchain technology for their CBDC. But it's important to realize that those are fully backed central bank approved digital currency, so they don't appear as as liability in the balance sheet, and therefore they are not in the entire system of the creation of money as like in the bank deposits. So whereas in other areas other countries that we see in Singapore and to some extent Thailand and Hong Kong, they look at things slightly differently. So the CBDC is part of the liability of the balance sheet. So with that, you can actually will have the kind of monetary transmission mechanism that you can see. But my point today in the talk was that what Cambodia and China has done, there are merits in having central bank approved digital currency where it's not part of the liability, especially for financial inclusion and corporate inclusion, which I think Professor Wong has mentioned earlier on, that you need to, because the fact that you do not have to have, in the case of settlement system, you always have to have a certain reserve to ensure that at the end of the day, there's enough to settle for whatever interbanks that you have. But in the case of CBA, you don't really need that. And because you don't really need that, therefore the counterparty risk and also the savings from having to have reserve put aside to settle for this, because it's already done. So as far as the intermediaries are concerned and the central banks are concerned, it doesn't impose further costs on that. And therefore the cost of service to the people is a lot lower. And a lot of reason why banks are not able to do that is because the cost of the payment system is very high. So in this way, the cost of payment system is much lower because there's no counterparty risk in that sense. The settlement is almost real time, and therefore for retail, it makes a lot of sense, and because it's also off balance sheet, so it's function like cash. It's just like a monetary base that you have. So with that, it is a very innovative way of it's an addition to your coins and your notes, right? The bank deposit is electronics, but here it is electronics, but it's classified the same as bank and notes and coins. So that is very powerful to be able to serve the underserved. And also that you can bring the payments company in together with the banks. You know, the difficulty is that if you have, for example, you have certain, like in China, they have a lot of centralized platform, right? The settlement is one party, two party, or three party settlement. But over here, you don't have that. So you may think that some of the payments company are able to serve the underserved in China, but as time goes on, when you start regulating them like bank, then the cost will go up. But in this new CBA, it's a totally different game altogether. I hope I answered the question about retail.
Okay, yes, yeah. It's perfectly answered the question. Thank you very much, Prof. Tu. And the next question goes to the representative from the Bank Jateng. Bapak, we have some question from Mahendra. The first is, what is the digitalization of the Central Java Bank look like? And then will it be application-based for smartphone? The second question is, how far has the development of the digitalization of Bank Jateng been, and when it is projected to be completed? And the last question is, what are the challenges for the Bank Jateng to go toward the digitalization? So please, Pak.
Try to answer the question. So basically, currently, Bank Jateng tried to catch up what the Fintech that already have. Yeah. So the bank trying to catch up this innovation that currently the Fintech done. So actually, I can see this from two different perspectives. First is, we always mention about how the Fintech will become the bank. So we see the other way around. We see that how the bank can be a Fintech. So for example, Dr. Wong, that you mentioned about decoupling the fund and the interest rate for the credit. So we already done that also. So we already, if you see our second use case, we use the BPR as a platform. So we distribute the working capital coming from the government to them, and they try to give to the other, to their customer. So basically the same concept, like you mentioned earlier. But this one is, we're still using the physical platform, which is a BPR for us. So it's a matter of, digitalize this manual physical one to be a digital company. So that's I think that's easier. That's easier because we already have the risk management. So it's a matter of bringing the technology to this physical platform. That's currently we have done that. So the question is, what is the challenge of our digitalization? It's about, the bank is always a highly regulated, institution. So the Fintech has the advantage on this in that area because the regulation is, a bit loose compared to the bank. So that's our challenge at this moment. So thinking of the government also will give the bank the right to create a sister company, technology sister company. So we see that as one our opportunity to compete with the Fintech. So if we can create the digital company, act as a Fintech one, but equipped with the risk management from the bank side, okay? So we will have a perfect harmony there in that company. So that will be our vehicle to compete with this market. I hope that's answered the question.
Yes, for sure, but thank you very much. And it would be the last question for our today's webinar. The question is goes to Dr. Pamungkas. And the question coming from Alia. Thank you for your brilliant presentation. May I ask what kind of approach the fintech lending companies in Indonesia can take to help MSEs, especially in the rural areas? So, Dr. Pamungkas, please.
Yes, we have, I guess, as Pak Imansyah mentioned, we have a lot of peer-to-peer platform that can help these customer or help the SMEs. And I would like to mention, if I mention the platform, it would kind of this promotional endorsement, but we have several type of peer-to-peer lending that really concentrate in one industry, like education, like in the agricultures, and also for consumption, and also for SMEs. We do. Let's say we can have like modal rakyat and like Mekar, like we have a lot of prominence and big peer-to-peer lending platform that can help the SMEs. Other than that, peer-to-peer lending is this alternative funding to fund the firms, but you can have also the subsidized loan from the government to help the SMEs to go digital, to have the adoption of the digital. No necessarily need to get exposure for peer-to-peer, but you can use the other source to finance your firms or the SMEs. I think that's all to the question for Arya. I hope it can answer the question. Thank you
very much, Dr. Pamungkas. And I'm afraid that it will be the last question for the today agenda. I'm very apologize to all of the participants that already gave the question to us, but I cannot bring up all of the question due to time limit. So on behalf of the organizing committee, I would like once again say thank you very much to all of the invited notable speakers to delivering such insightful and give us the shed light on the material for today, the financial development transformation, digital transformation and economic uncertainty. We learn a lot from a different point of view. We learn a lot from the regulator, from the Central Bank of Indonesia, from the Indonesia Financial Service Authority, along with the Indonesian Deposit Insurance Corporation. And we also learn how the even regional state bank successfully embrace the technology improvement and give a beneficial to the customer. And we heard a lot about the new theme for the Professor Chon and Professor Muckley that cannot joining us until the end of the session. They deliver such a very interesting material also with the Professor Lu, Dr. Lee, and also Dr. Wong. Once again, on behalf of the organizing committee, I say thank you very much. And to all of the participants, do not forget to fill in the attendance list. And I also once again to say thank to the supporting partner of today's webinar, the Central Bank Indonesia, the Indonesia Financial Service Authority OJK, Indonesian Deposit Insurance Corporation LPS, last but not least, the Bank Jateng. So I'm the Doni Chinese on behalf of the organizing committee sign off. Thank you very much. Stay safe everyone and hope to see you in the next event. Bye.
Thank you.